our markets are the envy of the world.
You do need tech to keep delivering. Luckily for us, they have been delivering.
You've got, I think, a little bit of froth showing up.
Meme stocks are back. Crypto's rallying. That's what I'm worried about.
There's going to be continued volatility. Use it as an opportunity to buy the dip.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Big tech leading yet again on the heels of AI's astonishing impact with a busy day of earnings ahead. Meanwhile, bond traders boosting bets for a September rate cut as San Francisco Fed President Mary Daly says she can't wait forever. And trade tensions swirling as the focus turns to India and where it buys its oil. Perhaps there's still capacity for the trade story to invade markets. But right now, Annmarie, markets are moving on.
They're moving on. We are just shy from record highs. Once again, the president touting this last night on Truth Social about the rebound we've seen in the stock market. And all this has to do with what you outlined, the impact of AI. Look at what happened with Palantir. The fact that the markets are just brushing off the labor market or taking in stride, because this means potentially there's a 90% chance they're going to cut in September. What I would warn is that we are less than 48 hours from these tariffs to actually take effect, because we do have the instructions now from the Border Patrol about how they are actually going to start to incorporate these new tariff rates. And there's some loose ends when it comes to some countries. What I would just say is that when it comes to trade and tariffs, the president likes to use this as a tool in his toolbox for other measures as well. And this trade story will stay with us the entire 4 years, so 3.5 more years.
Yeah, and it's going to create a level of uncertainty. We are seeing that in some earnings with ranges that are pretty wide in terms of earnings. Yet a lot of the research really just points to the fact that we've seen a massive earnings revision higher when it comes to forecasts. And frankly, as you mentioned, the AI promise seems to overwhelm all concerns about policy. And that does seem to be the presiding sentiment.
Exactly. We're going to have Dan Ives on, who's going to talk about the messy of AI revolution, Palantir hitting its next stage.
Sound just like him.
Next stage of growth. But when Palantir talks about what is the next stage of growth, they're looking at more earnings. A lot of this coming from things like government contracts and policy out of Washington, D.C. And key to that is that they need less people to do it.
And this really is going to be the key question. How much and how long can earnings continue to drive, given the fact that there's some real concerns about the economy? We were talking this morning. We still can't get over Friday. I know it's Tuesday, but we still can't get over Friday and how much of a blockbuster day it was. Not only did we get the labor market report, we got the BLS revisions that caused a firing to the head. And then you had, of course, this expectation that the Fed would cut rates. When you put it together, what is your takeaway in terms of what you are watching this week from a response from Washington, D.C., who replaces the Bureau of Labor Statistics, what the ultimate goal is, and how do you just position this as not just shooting the messenger?
Well, two things. One, the president said we were going to get new names this week. Well, we haven't gotten them yet. So we should get a new name of who's going to be the new BLS commissioner, and also who is going to fill Kugler's seat. Now, in both those stories, one, when it comes to Labor Department data, does the market take the data as credible, given the fact that this was a firing, or they're going to view this purely as political? And then when it comes to the Fed, is the Kugler seat, as Terry Haynes of Pangea Policy said yesterday, now just a regular governor seat, or does it take on a whole new meaning what he thinks? Because obviously they are looking for who is going to be the next Fed chair.
When you put all this together, all I know is that yesterday NVIDIA, Microsoft, and Meta all closed at record highs. And what you're seeing right now is markets pushing, adding to gains after yesterday's blockbuster day of returns, given the fact that it was the biggest single trading session since last May. We see that with a lift coming from the Russell 2000 in particular, up 0.3%, NASDAQ up 0.2%, with this expectation that the Fed is going to cut rates. On the agenda today, we're looking at the trade balance at 8:30 a.m., ISM services data at 10 a.m., and watch this space, a slate of auctions coming out, starting with the $58 billion of 3-year notes. It is going to be the busiest week of auctions going back to May as the United States does continue to refinance itself. And don't miss the AMD earnings after the bell as we continue with the earnings train. Coming up this hour, Jack Caffrey of JPMorgan with stocks climbing, Rob Casey of Signum with President Trump threatening higher tariffs on India, and Lauren Goodwin of New York Life warning that the Fed's cutting cycle might not be straightforward. We begin this hour with stocks rising after having their best day since May on solid corporate earnings and a renewed rate cut bet. And meanwhile, Jack Caffrey of JPMorgan writing, with the weakness, we have gone from a market with distinct cyclical and secular underpinning bias to a more unique setup. Jack joins us now. Jack, the unique setup has a lot to do with AI and the fact that that seems to overwhelm all concerns. Is that how you see it?
Certainly when you look through, the market continues to be dominated by the Magnificent Seven, and then to a much lesser extent, the forgotten 493. And as we've worked our way through earnings season, to some extent, your biggest and best news has been less about the earnings and more about the capital spending boosts that so many of these companies have been talking about in order to try to make AI the reality. And then ultimately turning to how do we start incorporating how AI is actually improving the quality of our business.
So, go ahead.
That remains sort of, if you will, the trillion-dollar question in the markets of how this spending will ultimately turn into higher margins, better growth rates, and ultimately returns to shareholders.
We knew this, though, on Friday. We knew this on Thursday. Suddenly, on Monday, yesterday, there was a renewed sense of vigor and excitement. How much of this is coming from the expectation of rate cut bets and hopes that maybe the economic data wasn't as bad as it looked?
Well, I think ultimately, in a world of the earnings are in the future, the fact that you can start trying to come up with a scenario of lower discount rates for those future earnings makes them somewhat more valuable. Why that all happened yesterday morning, I wish I could come up with a better answer than it was Monday. And maybe there was a merger and someone had a really good bit of earnings news for animal health early in the morning and saw their stock up 30%, so we should buy AI in response. You know, day to day, trying to figure out why markets moved is challenging, even after 30 plus years of trying to do this. Talk about 18, 12, 18, 24 months, I think I have a better sense of what's going to be driving things. And that'll come back to the earnings story has gotten better. 2 weeks ago, I would have told you we're expecting earnings growth of 5% this year, and now it looks like it's going to be closer to 7. 7 turns to 12 next year, and it's August, and I start turning not only to what you've done for me recently, but what can you do for me next year? And I think getting to this idea of trying to find their way to policy clarity becomes really important. All right, we've gone from a massive cone of uncertainty for tariffs. Now we have a much better sense of what they look like for major trading partners. We have tax sense clarity on what taxes look like, where can I spend, how I benefit from that. And so I think ultimately companies will do the right thing. They're really good at managing their margins over the long term. And I think that sets us up for where people are starting to look for where's the good news coming from next.
When it comes to policy, we have an outline of what the policy is, but now it's going to take effect. Last year, we had a tariff rate of 2.5% on average. Now it's going to be about 20%. How is that going to hit the earnings and the companies you're watching, especially the 493, not the 7 in the S&P 500?
Well, I think let's start with the U.S. economy is really a consumption economy. And so ultimately, we have to figure out how much of that tariff boost, that 20%, is shared between the consumer, companies reducing their margins, or whether exporters actually decide, you know what, I'm going to give the U.S. a discount. And I do think that we have ongoing academic debate on whether tariffs are one and done from an inflation perspective. The fact that, as you pointed out 5 minutes ago, that what we think is certainty is actually not certainty because this hammer in the toolbox seems to be deployed frequently. And so will you have consistent impacts on inflation rates coming through the variability of policy? And that's where I think today's data should really, my issue is what does the ISM services come back to? Because again, this is this consumer-led economy. Tariffs, ultimately, if you thought that they were designed to try to encourage reindustrialization of the United States, policy which is both desired by Democrats and Republicans, runs into, we already have 600,000 empty manufacturing jobs trying to hire. How do you actually convince people to take those jobs without paying them more? And last time I checked, that was a potential supply shock to inflation.
You said you're looking forward to the data that comes out today. Where are you thinking in terms of the credibility of this data, given the fact that the president last week didn't like the jobs number and then fired the head of the BLS?
I think U.S. economic data is the envy of the world in general, but we do know that there are some issues. You've been having stories for at least a year now about falling response rates, and the reality is, we haven't completely used AI to get all the economic data in real time. Certainly, the one thing I have certainty in life is economic data will be revised. And when I sit back and think what we were hearing, a week and a half ago at this, probably sitting in this seat, someone talking about, I'm seeing real weakness in the goods producing sector of the economy. And yet then when we got the data on Friday, the weakness was actually the revisions, and the weakness in the revisions was primarily in government. So to some extent, we knew when you've been talking about the scale of job reductions in the federal government, at some point that was going to work its way into either initial claims, it would work its way into job elimination. So you're left with, we didn't know timing, but we knew that was something that was going to work its way into the system. Unfortunately, it managed to work its way into the system the same day that the actual job creation number was on the weaker side. I'm not sure that eliminating a job because you don't like the answer, it feels kind of very ancient Roman. In terms of how you respond.
Sure. At the same time, some people are saying this actually gives the Fed, actually most people are saying this gives the Fed a lot of ammunition to cut rates, and you're seeing a 91% chance priced into Fed funds futures. How much do you see this really mandating a cut in September and mandating at least 2 cuts this year, and that actually being a positive for equities, given the fact that the underlying weakness might not be as great as maybe the revisions might suggest?
I mean, consensus has been, I think, for 2 cuts this year. The question was really, was it going to be July? Was it going to be August? By the way, Jackson Hole, coming up in a few weeks, tends to have had sort of an above average policy impact ever since the global financial crisis. So I do think that we certainly have a nice big window for the Fed to consider, look at the data. I think, coming back to this idea of the direction is lower rates. I think the question is, do we get it quickly or not? If you look at, the slope of the yield curve, 2s10s suggest that is more or less priced in. 3 months, 10 years, that curve is still inverted. So I do think you do wind up looking at the bond market is trying, if you will, to force the Fed's hand. And the Fed is left with, I've got 2 mandates. I hadn't seen until Friday the employment picture actually cracking or weakening. And I've got inflation that's still running 2.8, 2.7, 2.9, depending on which survey you look at, still comfortably above 2. Yeah. Lies, damn lies, and statisticians is at 40% above trend or 80 basis points. Yeah. Depending on which channel you listen to, you get a different take on it.
Jack Caffrey of JPMorgan Asset Management, thank you so much for joining us this morning. And we are hearing from Fed officials, in particular San Francisco Fed President Mary Daly, who said this yesterday: I was willing to wait another cycle, but I can't wait forever.
And basically her point is that it sounds like she's thinking we should cut. She's been nervous about the labor market. And then if they do see the impact of the tariffs on inflation be more than just a one-time price adjustment, then they can adjust themselves. She also went on to say, which I thought was interesting, I think the more likely thing is that we might have to do more than 2. We also should be prepared, in my judgment, to do more if the labor market looks to be entering that period of weakness and we still haven't seen spillovers in inflation. Sounds like she's prepared to join Waller and Bowman in September.
And we might be getting more than 2 rate cuts. Right now, we'll be speaking about that coming up. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. We start with Palantir. Shares are surging in the pre-market, up 5.4% after reporting a 48% increase in revenue to more than $1 billion. The company citing the astonishing impact of AI on its business in the second quarter, leading it to raise its full-year outlook to over $4.1 billion, far beyond analyst expectations of $3.9 billion. The stock is on track to hit an all-time high at the open. Meanwhile, Texas Governor Greg Abbott has ordered the arrest of Democratic lawmakers who left the state to block a vote on new congressional maps. Abbott saying the lawmakers abandoned their duty to Texans and that they could potentially face forfeiture of their elected office. The tensions now have governors of other states looking to redraw maps in their states. And Saudi Arabia's Aramco reported a drop in profits for a 10th straight quarter as lower oil prices hit the company despite its increase in production. Earlier this year, Aramco said it would lower its dividend for 2025 by a third to about $85 billion, but it's still struggling to churn out enough cash to cover the distribution. Shares are slightly higher. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the president's push to open markets.
All of the deals are premised, and the modified rates for these countries are premised on them actually opening their market. And if you don't, you can have the tariffs go back into place. This is basic trade enforcement. That's what we intend to do here.
And we will be discussing that coming up next with Rob Casey of Signum Global Advisors. This is Bloomberg Surveillance. We're seeing a little bit of a lift after yesterday's blowout earnings as well as the blowout returns on the S&P 500. The biggest one-day gain across the board going back to May, driven by big tech, building on that with 0.2% gain. A little bit of dollar strength after yesterday, seeing that come off just a touch, and 10-year yields up 2 basis points ahead of a slate of auctions. Under surveillance this morning, the president's push to open markets.
All of the deals are premised, and the modified rates for these countries are premised on them actually opening their market, making the investment and purchase commitments they've agreed to. And if you don't, you can have the tariffs go back into place. This is basic trade enforcement. That's what we intend to do here. This is once in 100 years that you have the chance to reorder global trade like this, and we're doing it, and we'll use whatever tools are necessary to do it.
Here's the latest. President Trump vowing to, quote, substantially raise tariffs on India over the country's Russian oil purchases. India's Ministry of External Affairs calling the move, quote, unjustified and unreasonable. Bloomberg's Mike Shepard joins us now. When we talk about opening markets, what do open markets under President Trump's rule look like?
Well, open markets under President Donald Trump really look more like what Jamieson Greer, the U.S. Trade Representative, was just outlining in that interview clip we saw. It is really not just about lowering those tariff and non-tariff barriers, and that is one of the key issues at stake with India. India, besides the whole question of Russian oil purchases, has in place some of the highest tariffs on U.S. products, and that has been a sore spot for the Trump administration, as well as other non-tariff barriers on goods, especially agricultural products. So the administration expects, a lowering of those impediments to trade for U.S. goods, but it also expects, as we've seen from other major economies, including Japan, South Korea, and the European Union, some pledge to invest here in the U.S. domestically. And while those promises from other trading partners are a little vague in terms of what those billions and billions of dollars in investment in the U.S. would look like, would it be through a sovereign wealth fund? What form would the investments take? Would it be in energy? Would it be in tech? A lot of those questions remain unanswered. But the administration, at the very least, Lisa, wants to see some sort of pledge in that direction as well. Now, with India, there is the additional sore spot of its purchases of Russian crude. And this has really gotten under President Donald Trump's skin because it is, in his view, an impediment to ending the war in Ukraine. This is a promise that he had made, and he had tried to curry favor with Vladimir Putin to get both sides to the bargaining table. But now he has soured his tone toward the Russian president, and he is taking it out as well on Russian trading partners, especially India, when it comes to those purchases of crude. Now, for India, they are looking at ways to maybe get out of this pickle, and that could include more purchases of U.S. energy products, but it also will rely more on some personal diplomacy. Indian Prime Minister Narendra Modi had enjoyed a more chummy relationship during the President Donald Trump's first term, but we have seen that bromance fade. And we have seen since then that Modi has turned to his own populace in the last week or so, saying, look, buy Indian products, buy local, and he is really trying to stand his ground against the U.S., and that is a stance that we're also seeing echoed in another BRICS country, and that is Brazil, where another eye-watering level of tariffs of 50% in a separate dispute between Washington and Brasilia. We're also seeing tariffs emerge as an instrument of policy there, too, Lisa.
Mike Shepard of Bloomberg, thank you so much. Always great reporting. Joining us now is Rob Casey of Signum Global Advisors. We just heard Shep lay out all of the potential tariff uncertainty as well as tariff squabbles, quabbles that we've been hearing about, and yet markets are pushing toward record highs. Why are markets so sanguine about all of these risks?
Well, I think the truth of the matter is that since Liberation Day, we haven't had the kind of, one big, beautiful gasp of markets, right? We haven't had that real shock factor. And I think you have to give President Trump some credit for this. He's continued to socialize relatively high levels of tariffs, not over the past couple of weeks or months, but over the past number of years, right? And so I think markets are able to see through some of the day-to-day announcements because we've been having day-to-day announcements for months now.
So is Thursday an actual deadline?
I wouldn't say that President Trump has any actual deadlines, right? I do think that he likes to maintain his ability to maneuver, right? I think that's part of President Trump's ability to maintain leverage. So is Thursday a drop-dead as of Friday morning, we're in a brave new world and everybody knows exactly what's going to happen from there. I don't think so. I do think Thursday is a point at which, kind of as we've seen over the past number of weeks, we get a little bit more information, maybe one or two more deals. And even though those deals are vague, right, we're getting to a place where, okay, there aren't so many outstanding variables.
So Shep outlined all the concerns and problems right now in the relationship with Delhi and Washington. Do you think that India is able to get a deal with this administration? It seems like a massive U-turn from where they started in the beginning, with Modi coming to the United States and then preparing to be one of the first to ink a deal.
Yeah, we've always felt that, the U.S.-India trade deal, as difficult as the details may be, and all these deals, right, have plenty of details, it was as simple as the fact that President Trump and Modi have a good relationship. They both want to get this deal done, and so they both will, right? It's very much a top-down negotiation process rather than maybe a more bottom-up negotiation process a la U.S. and EU. I take Shep's point that the relationship is not as positive as it has been, but we still think that there is, kind of residual positive vibes, and the fact that there is still, let's say, some wiggle room or some middle ground, right? We may see more U.S. agricultural exports to India. That's a relatively obvious carrot that Modi can still give President Trump to get a deal done.
What happened with Switzerland? They got a 39% tariff rate. Now we're getting reports from the Swiss government after saying we can offer a better deal for you, that a Swiss leader is going to Washington, D.C. to discuss the tariffs. What happened there, and what exactly is this president looking for?
Well, I think we heard it on the show yesterday from Ambassador Greer. They are still willing to talk, right? If a country is unhappy with the deal that they got and they want to, ring the USTR, if they want to ring President Trump, then the Trump administration will listen, right? So I think in Switzerland's case, rightfully so, they were unhappy with the deal that they got. I think they will continue to negotiate, which, leads us back to the fact that there are no deadlines, right? Because even a hawkish tariff rate that's put in place can still be negotiated down.
Let's be really clear. It's bringing in a lot of revenue. A lot of people are talking about just how many billions of dollars these tariffs are bringing in. Some people equivalating them, creating some sort of equivalency with the VAT tax, and saying essentially they're going to be really hard to remove post-Trump, just simply because who's going to want to do that and then raise taxes on the other side? Do you see this as a permanent structure for the United States going forward?
Well, I think we're getting there, right? Because the truth of the matter is these things are going to be relatively hard to unwind for the next president. That being said, if the next president is, J.D. Vance, I think we would see a doubling down on these ideas, right? Kind of generally speaking, this ideology. If the next president is a Democrat, then I don't think it's that difficult to say, we want to lower prices, we're going to bring down tariffs, right? And maybe we'll find revenue elsewhere. Maybe we'll tax the rich. We haven't seen Republicans or Democrats really make that happen so far. 3 years from now, we'll have a conversation.
But Biden had a chance to do that when it comes to the Chinese tariffs, when inflation was sky high and they were trying to pull any lever to bring inflation down. They talked about it, oohed and ahhed, for about 7 months, and still the decision was we're going to keep the Trump tariffs on. Yeah,
I think that's a really good counterexample. It's a lot easier to be hawkish on China than it is to, say, be hawkish on Switzerland, right? So I think that there's political space to maybe remove a tariff on Switzerland where there isn't political space to remove a tariff on China. Maybe a political space to remove some of the tariffs on Southeast Asia, right? So, Annmarie, I totally take your point. Some of these are going to stick, right? And that's President Trump's intention. But if we have a Democrat in the White House, I don't think they'll all stick.
I think you're underestimating the anger against Switzerland and Canada, Rob. I think that you need to right-size that. Rob Casey of Signum Global Advisors, thank you. We are hearing more that the Swiss leader is heading to Washington, D.C., Annmarie, and that's going to come as soon as today.
This is a big move. This is the president and the economy minister, the president of Switzerland, and President Trump had a phone call. It did not go well. So this is an opportunity for them to get back to the negotiating table. I was told there was actually a negotiating text agreed upon. It just needed this phone call to get it through, and it didn't go too well.
We'll update you when we get more on that coming up. Lauren Goodwin of New York Life joining us next. Building on gains from yesterday after the biggest one-day gain across the board since May. And yesterday's gain, I should just say, was completely broad-based. More than 80% of the S&P 500's members ended the day higher. Meanwhile, you see that continuing, led by the Russell 2000, possibly on rate cut bets, up about 0.5%. NASDAQ building 0.4%, and the S&P up 0.3%. 3 hours from the cash open, with tech leading. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, here's what's behind that tech lead. It is by far Palantir this morning. Reported earnings after the bell yesterday. Shares are up 5.4%. It was a 48% increase in revenue to $1 billion. The CEO saying it was because the astonishing impact of AI. I also wrote down what he said, kind of taking a jab at Wall Street, who's had a love-hate relationship with the stock, saying the skeptics are admittedly fewer now, having been defanged and bent into submission. How is that for a CEO statement? Now, elsewhere, the chip makers in focus this morning. We're going to get earnings from AMD and Supermicro Computer after the bell, but they are rallying in advance in that, probably thanks to Infineon. The German chip maker reported earnings this morning, said it sees a lesser tariff impact than expected and assumes that their margins will increase. So now the bar has been set high for these chip makers. Finally, rounding it up with a loser, one of the biggest losers in the S&P 500 pre-market this morning. That is Vertex Pharmaceuticals. Shares are down 15%. It's been trying to develop an experimental pain treatment without the use of opioids. In a recent study, the FDA ruling that it was not strong enough. So that negative study sending shares lower pre-market. Lisa.
Thank you so much, Danny. Right now, we're watching this. President Trump vowing to, quote, substantially raise tariffs on India over the country's Russian oil purchases. This coming after Trump announced a 25% levy on the country last week, one of the highest of any major economy, in an about-face after what was believed to be a pretty positive relationship.
Right. Remember when we said in April that this is going to be one of the countries that quickly out of the gate is going to get a deal, alongside maybe Japan and some others. And actually, we've seen the European Union get a deal before the likes of India. I think with this, the Trump administration is viewing this killing two birds with one stone. One, they have issues with India right now to figure out the final agreement. So they are trying to put some pressure on New Delhi for concessions. At the same time, Trump has another self-imposed deadline for Moscow and Vladimir Putin this Friday, saying that Putin needs to come to the table for a truce and a ceasefire agreement. He even sent Steve Witkoff there. He's going to be going there in the next few days. So by doing this, they can also put pressure on India to stop buying Russian crude. And yesterday, we had the NATO ambassador, Matt Whitaker, on Bloomberg TV talking about secondary sanctions and tariffs against those that are paying for this war, like China, like India, and Brazil. But it's much easier to put pressure on your friends like India than it is to get China to do your bidding.
I wonder what it means for the likes of Apple. We talked about that earlier, about how they were looking to move production out of China into India. How do you come up with some sort of long-term plan around supply chains if you have this type of shifting sand backdrop?
It's very challenging because one day the tariffs are on, one day the tariffs might be off, one day potentially there's a threat, the next day potentially there's a deal. Usually when things and the rhetoric gets very hot, that actually signals potentially they're closer to a deal than you would think. But it's very challenging for a company to decipher between this, especially when you're at the moment somewhat out of favor. I am still struck by the fact that the President of the United States on the Middle East trip continuously kept calling out his new best friend, Jensen Huang, the NVIDIA CEO, and also kept saying who's not there. His friend Tim Cook didn't decide to come.
Well, we're talking about the potential tech prowess and who gets what. TSMC discovering a potential trade secret leak about its chip-making techniques. The NVIDIA chipmaker launched an internal investigation, has initiated legal proceedings after identifying the issue, quote, early, raising questions about TSMC's dominance, and they've only solidified that dominance over chip making over the past few years.
Absolutely. This is the world's biggest chip maker. Now they're going to be at least looking at this internal investigation. The concern always is from a national security perspective, and has been from the United States when they put on things like export controls, is any of this data, any of this tech leaking to China. And that is why this is going to be very concerning for individuals in Washington.
Meanwhile, we've been talking about data dependency taking on a new meaning as we look at the potential downward revisions as well as some of the changes at the top. San Francisco Fed President Mary Daly saying they might need more than 2 rate cuts this year. Daly citing growing evidence the job market is softening and saying there are no signs of tariff-driven inflation. Look, To me, she's been actually harping on this for a while. So this even was before some of the jobs data, but it highlights the concern and how split the FOMC really is when it comes to the balance of their mandate.
I think it was David Seif of Nomura that said to you and John last week, this one-man rule dictatorship at the Fed is over. That regime that we've seen for decades is over. There's going to actually be, we saw the double dissenters. Now you have someone like Mary Daly coming out. To your point, she's not running. She's been in this camp for a very long time. But there's actually going to be a huge debate at this September meeting. It's going to be, I think, one of the most interesting Fed meetings we have this entire year.
I mean, she might be running. We don't really know. We'll find out. But meanwhile, sticking with the Fed, Lauren Goodwin of New York Life writing this. We discourage investors from assuming a September cut would signal a series of cuts thereafter. Our Fed cuts checklist still signals risks from all sides. Lauren joins us now with what is increasingly out of consensus view. Lauren, how do you look at what we got on Friday and the labor market data, as well as the lack of some sort of sustained inflationary impulse? Put that together and say we could even be talking about a rate hike.
Yeah, well, so I think what the market is telling us after Friday is that the Fed will be leaning more towards the demand destruction we're seeing in the labor market than inflation in September. And on balance, I agree. I think that we're likely to see a rate cut in September pending the data that we get between now and then. Where we caution investors is assuming that a cut in September means anything about October or December or meetings thereafter. And the reason for that is that as we look at the things that the Fed cares about, the labor market, we're seeing some weakness on the demand side, but we're also seeing a deterioration in labor supply. And this is something that I think the market conversation is not paying enough attention to, because that deterioration in labor market supply might mean that 15, 20,000 jobs a month is actually a healthy labor market. It might mean that the unemployment rate isn't going anywhere, or that wages are moving potentially even higher. That's a market reaction function that we're not used to as investors, and something that I think we have to consider as we see more data between now and September.
So are you saying that we could still see one rate cut this year, or maybe two, but nothing more than that? Is your argument essentially that people are overestimating any potential weakening in the labor market that could curtail the inflationary kind of overlays?
That's my view today. Now, if we think about the things that the Fed cares about, we've talked a little bit about the labor market, inflationary pressures. I tend to agree with the market that we're unlikely to see a major reacceleration of inflation, certainly nothing like we saw a couple of years ago. But we are probably going to be seeing prices move, core PCE inflation move back above 3% over the next few months. That's a tricky situation for the Fed. And if you add that financial market conditions have been very loose, equity valuations look great, credit spreads are tight, the availability of credit is good. Chair Powell pointed to this last week. That's a balance of data that doesn't call for an enormous amount of cuts. Now, I do think that what we saw on Friday in terms of the demand side of the labor market, that does concern me. But that balance of data is not only tricky, but a lot of the things that are impacting the data are supply side factors, things that the Fed can't control.
When it comes to the demand side of the labor market and the supply side, are you looking at potentially there's less participation because of immigration policy out of Washington, or what we're seeing in terms of the AI revolution?
At this moment, it's more related to immigration policy. So we're seeing, and this was confirmed in the numbers on Friday, fewer people participating in the labor force, frankly, just less labor supply, less labor availability. We're also seeing that companies are hesitant on hiring, and that has more to do with trade policy and let's call it general uncertainty. And so that balance of factors is one where there's not a lot of new jobs created. That's not the end of the world, but where I think it's tricky for the Fed is when you have not a whole lot of new jobs created while still having an unemployment rate that isn't going anywhere. That makes the reaction function for the market, looking at a weaker payrolls gain as something that actually isn't negative.
When you say that in the next few months you see inflation ticking up, is it all tariff induced?
It's mostly tariff-induced. So we see some stickiness in the housing market related to rates. Other than that, services disinflation has been pretty well pronounced. And it's one of the reasons why we do think that the Fed will be able to look through some of the goods-related inflation we're seeing and move towards a cut in September. But the challenge is that we've only just started to see that goods-related inflation hasn't included things like holiday buying that are just starting now. And so we do anticipate that prices are going to be moving in the wrong direction later this year. answer.
It's hard to figure out what's going on. It's even harder when you've got accusations of political interference and you've got questions about just how accurate the data collection is given the low response rates. You have a really interesting take on this, Lauren, that political interference with the Fed or the Bureau of Labor Statistics will push long rates higher, not lower. Why is the market not coming to that conclusion right now?
My read on this, and I've thought a lot about this over the weekend, but my read on this is that the market isn't seeing evidence of actual interference yet. We don't know who's stepping into Fed or BLS seats. We don't have really any indication that there is interference with these important independent functions. I think that calculus would change if the market does see that evidence, does see that data or Fed decision making is being tampered with. And the reason that we think that's important is that, especially in monetary policy making, credibility is one of the most important policy tools. And though there are an increasing amount of evidence that the Fed could be cutting rates slowly, stably over the next, let's call it 6 to 12 months. Some of the conversations I have with investors are, if we have a new Fed chair and we get 200 basis points of cuts, right away. That type of activity, though I think incredibly unlikely, is going to derail inflation expectations. And in anticipation that there were even, let's call it modest political interference, I think would mean that market interest rates, like the 10-year yield, would be moving higher, even if the policy rate were moving lower.
One thing that a number of analysts have said is that private data points cannot replace the gold standard, cannot replace the Bureau of Labor Statistics. And even some of the peripheral surveys don't really serve as a counterpoint for the labor market report. Given the potential for the market to not be tracking the actual economy in real time the way that they thought, are there certain gauges that you're watching for a better sense? Is ISM services that much more important? Is CPI? What's sort of the gold standard increasingly for you?
I have to say that the labor market statistics have had trouble now for more than a year, more than a couple of years, as response rates have declined in response to the pandemic. The BLS is still the gold standard. Of course, there's a smattering of data and evidence that we look at, regardless of what phase of the cycle that we're in. But when it comes to the labor market, it is about the BLS statistics. Now, what do we do to acknowledge that revisions are becoming larger, more likely, et cetera? Goes back to essentially economic fundamentals. One data point does not make a trend. I think what was really important about Friday's data point is that it showed that some of the early signs of cracks in the labor market actually did make a trend with the revisions that we saw.
Lauren Goodwin, thank you so much for being here. Lauren Goodwin of New York Life. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Japan's top trade negotiator is heading to Washington to push for a cut to tariffs on cars, as promised in its trade deal with the U.S. Before his departure, Ryosei Akazawa told reporters Japan will, quote, strongly urge the U.S. to take steps to implement the agreement swiftly and steadily. Tariffs on cars from Japan to the U.S. currently sit at 27.5%. Meanwhile, Israeli Prime Minister Benjamin Netanyahu plans to meet with his security cabinet on a fresh plan on achieving its Gaza war objectives of freeing hostages and destroying Hamas. This comes as Israel faces increasing international pressure on its war conduct as the UN and aid groups warn of widespread starvation in Gaza. And the U.S. is exploring ways to equip chips with better location tracking capabilities. A senior official sharing Washington is working with the industry to monitor the movements of these sensitive components as part of a broader plan to curtail smuggling and protect American tech dominance. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, a big, beautiful bond market.
It's a big, beautiful bond market, and returns have been substantial, and they are going up, right? Yields are really high, and we've been certainly advising clients, take advantage of these rates while they're high.
And talking more about that big, beautiful bond market, Simon Dangoor of Goldman Sachs will be joining us next. Tariffs? What tariffs? Right now we're seeing further gains after yesterday's biggest one-day return for the S&P and NASDAQ going back to May, building on that, up 0.25% on the S&P, 63.71. I remember when people were talking about four handles in front of the S&P. Meanwhile, a little bit of dollar strength, 115 on the euro-dollar cross, and yields creeping higher on the long end for 21%. Under surveillance this morning, sticking with bonds, a big, beautiful bond market.
It's a big, beautiful bond market, and returns have been substantial, and they're going up, right? Yields are really high, and we've been certainly advising clients, take advantage of these rates while they're high. You have a president, a Treasury secretary, and ultimately a chair of the Fed that all think rates should not be, again, 25 or 50 basis points lower, but potentially hundreds of basis points lower.
Here's the latest. U.S. Treasuries holding onto most of their gains from their best day of the year so far on Friday as more traders bet on a September rate cut. The U.S. is auctioning $125 billion worth of debt in the biggest week of Treasury note and bond sales since May. It's one of the things that might be tempering the rally that we saw. Simon Dangoor of Goldman Sachs joining us now. Simon, thank you so much for being with us. Are we correct in pricing in just 2 rate cuts this year, or is the bond market sniffing something out that there could be some steeper rate cuts in the future?
Hey, good morning. Great to speak with you today. We do think actually the front end of the curve offers some value here, because even though what we got last Friday really wasn't enough in and of itself to sort of seal the deal for something like 3 cuts over the course of the rest of this year, the setup is pretty interesting. If we get another weak report in the beginning of September reflecting August payrolls, and of course these revisions and patterns that we've been seeing have been sort of heading in that direction, then I think you can really start to frame the debate for more. And that seems to be something which is underpriced with the market. I think the key thing to watch in the next unemployment report isn't just going to be where the sort of headline payrolls come out, but is where unemployment rate comes out. If you get a 4.4 on unemployment, maybe the market can have a debate about whether 25 or 50 is right at the September meeting.
Wait, hold on a second, Simon. You think that if you do see an unemployment rate creep higher in the August jobs report, you could easily see a 50 basis point rate cut come September with enough of the committee signing off. Is that correct?
I think the market could certainly debate it. A lot will also depend on what the inflation picture looks like between now and then. Clearly what we've seen so far is more moderate pass-through of tariff inflation. We'll have to see what we get next week. There is going to be a pickup from that. But really what matters is what's going on in the rest of the inflation basket. Powell was pretty clear at the press conference last week that the working model of the Fed here is that they're going to see this tariff shock as a one-off price level shock. So if the rest of the basket looks more benign, we've got this weakening labor market picture. And importantly, unemployment is rising because, of course, as one of your earlier speakers talked about, the supply side of the labour market is in flux as well as demand, then we could certainly see that debate. Now, that's not a central case by any means, but there's an interesting setup in the market here, and that doesn't seem to be so fully priced by the front end of the curve. So we like positions in 2-year notes here.
We have one more jobs report due before the Fed meets and 2 CPI prints. Simon, what kind of CPI print could derail this potential cut in September?
Well, I think it's the mix that really matters here. So what are we going to be watching? We're going to be watching essentially the non-tariff parts of the basket. So services prices is going to be key. All of the data that we get over the course of the month as well about what the intentions of companies are in terms of pass-through are going to be important to watch too. But I'd really emphasize that I think this is a labor-first Fed. I think Powell, again, 6 times in the press conference last week, he talked about a softening in the labor market. And of course, that was somewhat proved out by the data that we got on Friday. And so we think that's the key thing to focus on here, unless we get something really shocking from the inflation numbers.
And the main metric he told us he watches is that unemployment rate. What number of an employment rate would you need to see for 50 basis points?
Well, I think it's really about trajectory here and the combination of the overall picture of what we're seeing with here. I think at the very least it would need to be a 4.4. Of course, what we got last Friday was a 4.2, but only barely a 4.2. It would take quite a big move to get all the way to 4.4, but if we saw that trajectory in the unemployment rate combined with another weak number in terms of the non-farm payrolls that would take the 3-month average potentially even lower, then that could be the setup that really gets the market excited about at least a debate about whether 50 should be on the table, and perhaps even some votes for that.
It seems like, Simon, the bond market and the stock market are singing from two different hymnals. You have the bond market pricing in more weakness ahead, and you see it actually potentially underpricing the scope of that weakness and the scope of cuts that could be necessary. While we see profits surging, expectations for profits surging, free cash flow surging, and that's what you see reflected in some new highs in a number of stocks across the S&P 500 and NASDAQ. Where do these two stories meet?
Well, I think the S&P 500 isn't the full economy, and obviously the breadth in the stock market is something which has got a lot of focus. Look, I think that the Fed is in the risk management game. The stock market is very much trying to look forward to what are some potential positive drivers of the economy into 2026. Now, if the economy is going to be soft through the second half of the year, the Fed's got a role to play in order to make that bridge and to make sure that that bridge takes place smoothly. So I think there's a lot of uncertainty about how the economy is going to play out. The Fed policy, I think the stock market is taking some credit for that, but the Fed's got a part to play. And if we do get that weakening of the labour market, and I said that's not a forecast, that's a scenario, and I think that's, of course, what bond markets are focused on, then the Fed has its role to play.
If the Fed's in the risk management game, isn't there a greater risk that they could preempt any weakness, cut rates, and lead to more inflation down the line, leading to a sell-off at the long end?
There's always that risk, but I think the starting point for the Fed, and they've been very consistent about this, is that they're at a moderately restrictive level of rates. And so even those people in the Fed who have a sort of reasonably high view of neutral rates here would take the view that we would be more than 50 basis points moderately restrictive. I guess the argument that I would make is that if we're seeing a weak labour market picture extend, then I think the question in the Fed will be, do we still need to be at moderately restrictive, or do we want to move reasonably quickly to something with a neutral stance?
Simon Dangoor of Goldman Sachs, thank you so much. Pretty bold scenario, not call, but scenario with respect to a potential 50 basis point rate cut in September. Something that Mary Daly sounded open to should the labor market data deteriorate sufficiently.
I'm looking at all the data that comes before the next Fed meeting. Next, another jobs print, 2 CPIs. More important, and Jack Caffrey was talking about this, maybe is going to be, and you'll be at it, the Jackson Hole Symposium. We're going to have Jay Powell talk about it. Does he start to say, yes, basically, we are seeing enough weakness in the labor market to me for leaning in on this cut in September. And this year's theme is labor markets in transition, demographics, productivity, and macroeconomic policy.
Yeah, it's going to be a fascinating meeting at a time where so many people are saying that the exodus of foreign-born workers, which some people say have been overstated in recent data, but has been presumed that along with artificial intelligence, how that has affected the labor market, those things put together lead to a pretty different set of circumstances for them to measure. I just wonder, to your point, how much the data that we have from now until September could determine everything, even though we've seen that revisions are a constancy.
Revisions, exactly. What did Jack Caffrey say? The only thing certain I know is that economic data will be revised. And to get to a 4.4 unemployment rate, or the trajectory of that, as Simon was just talking about, that might not happen just with one more payroll report.
This is really complicated, which is the reason why AI profit seems to be what people in the equity market are looking for. And frankly, they're seeing, and they are rewarding it. Coming up next, Brooke May of Evans May Wealth, Brian Gardner of Stifel, Tom Shapiro of GTIS Partners, and Amanda Lynam of BlackRock, as we do watch stocks build on gains from yesterday. Futures higher by about 0.25% on the S&P. This is Bloomberg.
Macro data has been quite resilient.
There has been uncertainty impacting the economy. Consumers are managing this, I think, quite remarkably.
There really aren't signs that the labor market is weak.
But with the revisions, it's a dramatically different picture to what the labor market is saying.
It's clear that the economy is adjusting to a period of higher tariffs. Either the consumer will eat it or corporates will.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Building on gains after the biggest one day of returns since May. Earnings just keep on outperforming expectations. Next up, AMD after the bell. And the drumbeat of tariffs still there, but no one is listening. Big tech dominating with traders sick of talking about policy uncertainty. And Annmarie, that seems to be my takeaway, is people cannot price uncertainty. They've gotten used to it. There is less of it. So they're focused on the earnings and what we hear from the promise of AI.
Promise of AI, all the spending that's going into it, and that is what they're looking at right now because the uncertainty of Washington is here to stay. And we see that today in the market, whether or not it's the back and forth between India and the United States right now, potentially if they can get a trade agreement, potentially if the president is going to put tariffs on them, higher tariff rates because of their continuous consumption of Russian oil, and also Switzerland. The Swiss president is now getting on a plane today to come to Washington, D.C. to see counterparts. Not sure if there's a meeting with the president because they don't have a deal. In less than 48 hours, they're going to be paying a 39% or hit with a 39% tariff rate. It's a debate on who pays what part of the rate.
Yeah, one reason why people have moved past it in markets, particularly in the United States, is they say this market isn't, and the economy is not driven as much by goods rather than services. We do get ISM services data coming up, as well as AMD earnings, and these two prongs of both the consumer able to spend as well as that tech story have really lifted U.S. equity markets in a massive way. I just wonder going forward how much that gets challenged with questions around the data integrity, especially after the firing of the head of the Bureau of Labor Statistics.
And what's so interesting about the firing of the BLS commissioner is, of course, that weak data print is actually what's also fueling this market. It means that the market is saying the Fed can look at this labor data, see that there has been weakening, see that the revisions show that it potentially is a trend, and they could potentially cut in September. Before the labor data came out, it was a 40% chance of a September rate cut. Now it's a 90% chance. But of course, the president didn't like the jobs report, fired the BLS commissioner. A lot of concern from the likes of even Neil Dutta, an individual that regularly touts a lot of progress that he thinks this administration has made, saying this can undermine market credibility.
Yeah, people are on hold waiting to see who they nominate to really replace that seat. And as Lauren Goodwin was saying, right now the market is in a wait and see mode to really say, okay, maybe this person could actually increase the integrity of the data collection process rather than just putting their thumb on the scale from a political perspective. In the meantime, we do have a slew of bond auctions as people try to parse through exactly what the data will be looking like in the CPIs, the two CPIs that we get in the one labor market report. Going forward, a big question on the Fed and how much they are going to cut. We were just hearing from Goldman Sachs that you have to start thinking about a scenario where the Fed could cut by 50 basis points come next month.
And Rick Rieder was saying that Friday after the jobs report, 50 basis point cut could be on the table come September. It really depends on the data. What Simon was talking about from Goldman Sachs, though, is he wants to see a trajectory of the unemployment rate ticking up 4.4%. But there seems to be more people that are siding with Governor Waller, Governor Bowman when it comes to the Fed. Mary Daly, I was willing to wait another cycle, but I can't wait forever.
Right now, markets are looking ahead to that prospect. You're seeing further gains in equity markets ahead of that AMD earnings report. As we do get a significant beat and raise across the board, we can see the Russell 2000 gaining 0.4% in the bond space, just creeping higher in terms of yields after yesterday's huge rally, the biggest one-day rally going back to May, and that's what we saw on Friday as well, when we did see some data from the labor market that did look like it was a lot softer than expected, and a little bit of dollar strength as we fade a little bit of the past couple of days. Coming up, we've got Brooke May of Evans May Wealth on a tech-driven market, Brian Gardner of Stifel on escalating trade tensions with India, and Amanda Lynam of BlackRock on rising expectations for rate cuts. We begin this hour with stocks gaining following robust corporate earnings. Brooke May of Evans May Wealth writing, technology has resumed market leadership. We saw AI hype translating to earnings. Brooke joins us now for more. Brooke, we did see a pretty amazing proclamation coming out of Palantir yesterday, and it fueled a lot of those expectations for more of the same. How much more can they deliver versus some of the questions people have about valuations that are getting pretty lofty?
Good morning, Lisa. Yeah, we think that it's all about earnings right now, and it's all about tech earnings. When you look at the earnings of the companies that have reported, specifically the Mag 7, In the tech space, 26% earnings growth year over year, compared to only 4% earnings growth that we've seen in the other 493 names. So we've got more tech companies ready to report. We've got NVIDIA coming up here in a few weeks, and all eyes are on tech because that's the leadership, and we think that it'll continue to lead the way.
Meanwhile, we've seen a number of different Wall Street firms come out and say maybe things are looking a little frothy. We saw that from Michael Hartnett over at Bank of America. Morgan Stanley, Deutsche Bank, and Evercore ISI analysts all said they could see a correction in the next few weeks and months ahead. Typically a soft period in the equity market, and things have gotten pretty heady. What's your take on that? I mean, is that something that you're expecting and kind of waiting for?
When you look last week prior to the correction that we saw, the VIX was only around 15, and that's nearing complacency. And if you're contrarian at all, that's a concern. You know, this tends to be the time of the year where the market peaks, August, and we tend to see some choppiness in the market starting in September. Typically, it'll bottom in October and then move higher through year end. Knowing what we know today, that trend wouldn't surprise us. However, what we've seen in the last year is that the market's moving more on headlines than it is actually on data. And so we don't know what headlines are going to come out over the next few weeks. That said, knowing what we know today, we would expect to see some choppiness come September, October.
When it comes to the earnings, what have you learned in terms of, especially the remainder 493 outside of the Mag 7, what have you learned in terms of the tariff impact and how corporations are really just guiding through them?
I don't think anyone expected to see the profit margins that we're seeing. They're above a 5-year high at 12.3% of the companies that have reported this far. And when we listen to earnings calls, CEOs and CFOs are telling us that they've been able to navigate higher tariffs. They've been able to cost cut. They've been able to improve their supply chain, and they've been able to pass on higher prices. So what we're hoping is that the tariffs will be absorbed along the way, some by retailers, some by manufacturers, and some by passing it on to the consumer. And if you spread out that pain, nobody really feels it, and it doesn't become detrimental to one area of the economy.
But of course, for the previous earnings period, it was a 10% tariff on all these trading partners. What do you think it means now that a lot of these countries are facing higher rates?
We think ultimately we're going to end in a range of 10 to 15%. So if we've learned one thing over the last few months, there's a lot of saber rattling. And then ultimately things end up settling at a lower level than what's initially threatened or proposed. So we think that we will see some volatility based on projected tariffs. However, ultimately, once there's more clarity and things have settled, then we think that we'll be in the 10 to 15% range, which has an impact, but it isn't necessarily going to be devastating to the economy.
Brooke, how much are you paying attention to the policy uncertainty around the Bureau of Labor Statistics and the firing of the head of that? Ray Dalio came out with a post on X saying that he actually would have fired the head of the BLS too, not for political reasons, but just because the data collection and the whole process of extrapolating some of the figures had become outdated. What's your view of how this is being cast and the potential risk in markets?
Well, the markets don't like uncertainty, and the sooner there's clarity, the better off we'll be. It is surprising, though, in learning a little more about how the labor statistics are calculated, that so much of it is manual. And so I wouldn't be surprised if there is a better way to automate it and to gather that information more timely and with, utilizing electronics instead of, manual surveys. But, to see a revision down of 258,000 jobs for May and June is astonishing. And granted, we've seen bigger and bigger discrepancies between what's initially reported and then the revisions. So we need to have those numbers tightened up. And I think the best way to do it is to rework the system and come up with something that's a lot more efficient.
Brooke May of Evans May Wealth, thank you so much for being with us this morning. Right now, we are seeing futures build with that promise of AI. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Switzerland's president and economy minister are traveling to Washington today to discuss tariffs. The Swiss officials say they will present a more attractive trade offer in an effort to lower a 39% tariff imposed by the Trump administration. Meanwhile, NVIDIA's main server assembly partner Hon Hai saw sales growth weaken in July compared to the previous few months, in a sign that tariff uncertainty is weighing on demand for electronics. Still, despite the slow growth, it expects third quarter sales to grow sequentially and year on year. And Blackstone employees who work at the firm's Manhattan headquarters have begun returning to the office 1 week after a gunman killed 4 people in the building. Employees were met by increased security and police presence, along with executives and counselors there to check in on staff. Blackstone informed its workers returning was optional and that it won't resume a normal schedule until next week. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, enforcing trade agreements.
All of the deals are premised, and the modified rates for these countries are premised on them actually opening their market. And if you don't, you can have the tariffs go back into place. This is basic trade enforcement. That's what we intend to do here.
Brian Gardner of Stifel joining us on basic trade enforcement. This is Bloomberg Surveillance. If you're wondering why equity markets keep building on gains despite all of the naysayers, just take a look at earnings. Some of the statistics are pretty shocking as we see futures continue to rise, with S&P 500 beating expectations with a 9.1% increase, triple the preseason forecast. That according to Bloomberg Intelligence. Meanwhile, the Russell 2000 gaining by 0.5% in futures as people look to the potential for a rate cut. When you take a look at what that means in the bond space, you've seen a real rapid rally in the front end of the yield curve, a massive decline over the past couple of trading sessions. Today, taking a little bit of it back, up 3 basis points, 3.7%, 10-year yield and 30-year yields, all of them a little bit higher, coming before a slate of $125 billion of bond auctions this week. A lot of people trying to see how that will be digested. There was a Japanese bond auction overnight that didn't go so well. Today, we've got $58 billion of 3-year notes sold at 1 p.m. You bleed this through the currency space. What do you get? Marginally nothing, but basically a little bit of dollar strength, euro weakness at 115, but fluctuating. A real question about where this pair will turn. Right now, under surveillance this morning, enforcing trade agreements.
All of the deals are premised, and the modified rates for these countries are premised on them actually opening their market, making the investment and purchase commitments they've agreed to. And if you don't, you can have the tariffs go back into place. This is basic trade enforcement. That's what we intend to do here. This is once in 100 years that you have the chance to reorder global trade like this, and we're doing it, and we'll use whatever tools are necessary to do it.
Here's the latest. President Trump vowing to, quote, substantially raise tariffs on India over the country's Russian oil purchases. India's Ministry of External Affairs calling the move, quote, unjustified and unreasonable. Bloomberg's Mike Shepard joins us now. Mike, there's a real question around what it looks like to have open markets. How does Russian oil play a part in that?
Well, Russian oil plays a different role altogether in this, Lisa, because Donald Trump is trying to use purchases of Russian energy products as a means of pressuring Vladimir Putin to end the war in Ukraine. He is trying to cut off what he sees and what European allies see as a key source of financial support for the war machine that has been going on for more than 3 years there now in Ukraine. And Donald Trump has tried at least at the beginning of his administration to cajole Vladimir Putin into coming to the bargaining table and taking a more favorable approach toward Russia. And that has not worked, much to his frustration. Hence, we're seeing a souring tone toward Moscow here in Washington. And we are also seeing the threats of secondary sanctions, as the president has called it, against Russian trading partners. And that in particular right now includes India, which is a top purchaser of Russian oil in particular. And they would be facing significantly higher tariffs on their goods being exported to the U.S. if they do not somehow cut those purchases and cooperate with the U.S. effort to rein in Vladimir Putin here. Now, the issue for India is also beyond just the question of Russian oil. They are looking at an eye-watering tariff level of 25% that would begin being charged on Thursday after 12:01 a.m. New York time here if they do not somehow offer other trade concessions as well. The president has been concerned that India is still charging too much in terms of tariffs on U.S. products, and also maintaining barriers on other U.S. products, including agricultural goods, preventing them from easy entry into India, one of the world's largest markets and a key U.S. trading partner. And we're also seeing misgivings among other nations that are facing high tariff rates as they're about to be charged later this week. Switzerland is one of them, and we see the president, Karen Keller-Sutter, heading to Washington with her economy minister in a hope of trying to get some deal in place before the 39% tariff against Swiss goods goes into effect and begins being charged. They were caught off guard last week, Lisa, during a call with President Donald Trump. The Swiss thought they had a deal in hand, but it turned out the president was questioning them about the tariff rate and surplus that Switzerland enjoys with the U.S. That trade imbalance was the focus of the conversation with President Donald Trump, and he questioned them in a way that really caught the Swiss off guard. They didn't have a good answer or a satisfactory answer for President Donald Trump, and they ended the call without an agreement, and hence the 39% rate that was announced last week, much to the surprise of the Swiss, and now they're trying to make a last-ditch effort to avoid it. It's unclear whether the president will actually meet with his Swiss counterpart when she arrives here in Washington, what the schedule will be, and also what sorts of concessions the Swiss government will have for Washington, and whether it will include more favorable treatment of U.S. agricultural goods, whether there will be other tariff concessions or anything perhaps related to pharma, which is one of the biggest products and exports from Switzerland into the U.S. And then, of course, there is always the question of investment. Donald Trump is using a lot of this trade negotiation with key U.S. trading partners as a way of getting them to invest more in the U.S. We saw that with Japan, South Korea, and, of course, the European Union. And he is trying to secure those commitments as a way of reshaping global trade in a way that favors American manufacturing.
Shep, thank you so much for all of that. And I am curious just how much of a surprise Switzerland really is and whether the president will meet with the head of Switzerland.
This feels like a Hail Mary from Bern. This is the statement from the government's office in Switzerland. Quote, facilitate meetings with the U.S. authorities at short notice and hold talks. It doesn't sound like they actually have any meetings set up, and they're coming here what feels like in a Hail Mary attempt. Remember, these tariff rates, that 39% goes into effect at 12:01 Thursday. So they need to do something pretty quickly and bold to get it back to the negotiated text they had before this phone call happened between Karen Keller-Sutter and the president that didn't go well.
Joining us now is Brian Gardner of Stifel. And Brian, I'd love your perspective on what the Swiss could offer the United States that could get President Trump's interest. Do we have a sense of what the parameters are, the tit for tat, that these negotiations have really borne out?
I think it's tough to say because it does feel like the goal lines have moved a little bit. You're reporting earlier about how the Swiss were caught off guard. It sounds like, and maybe I'm misinterpreting this, but it sounds like the U.S. changed the ask. And so that makes negotiations a little bit tougher. I do think, the president is very focused, has been focused throughout his entire adult life on trade deficits. So anything that the Swiss can do to convince Trump that they're going to shrink the trade deficit, I think is a winner. And then it gets to pharma. You mentioned pharmaceuticals. It's a big export from Switzerland. It's a big political issue here in the United States. The president's been running, since his first term, been talking about lowering prescription drug prices. So, that has to play into it as well.
But Switzerland is a top 5 foreign direct investor into the United States.
This is always the conundrum.
Yeah,
right?
So why are they not touting that more and using that in trade negotiations?
Yeah. I can't speak to what their strategy is and what their internal discussions are about how they approach the United States and negotiations with the United States. But that was a key part of the Japan agreement, was that the president got to tout Japanese investment in the United States. That is a model that the Swiss should be following. For the reasons that they're not doing it, I can't speak to.
The new rates come into effect in less than 48 hours. Who do you think gets a deal before then?
You know, for all the talk about no extensions, I think there are going to be extensions. We've already seen pauses and extensions. That doesn't mean there can't be more. These are complex negotiations. I think that the administration leaned into the no extension narrative because it's a good negotiating tactic. But the president is always a deal maker, right? And I think at the end of the day, if he sees some kind of movement that's satisfactory to him and the administration, they can back off and say, okay, we're moving in the right direction. We need a couple more weeks. But the holdouts so far, I think these are going to be tougher to get deals with. You're reporting on India before. Mike Shepard was spot on in talking about the non-trade barriers. Those are really the toughest barriers. Tariffs are kind of easy in the whole puzzle. They're the easier part of the puzzle. It's the non-tariff barriers, in particular with India. You're dealing with the agriculture sector, which is a domestic force in any nation, in any economy, and especially in India. So I suspect that the India negotiations definitely going to need more time, but it would not surprise me to see a series of extensions on these talks.
Sometimes this feels like an episode of The Peanuts, where people are talking about tariffs and we hear about them from Washington, D.C., and all the market hears is wah, 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 because they're focused on other things. They're focused on tech earnings and, frankly, even the BLS firing, as well as the Fed member resignations seem to ignite much more interest than the ongoing trade skirmishes. Do you think that's appropriate? Do you think that it's a bigger story, that we could get a changing of the guard at the Federal Reserve and that we will get a changing of the guard at the Bureau of Labor Statistics?
Well, first of all, any Peanuts analogy is always appropriate. I mean, it just goes a long way. I mean, it's time tested. Charles Schultz was a genius. I think we could get some clarity on the Fed and the BLS in the next coming days. There are a lot of questions about the Fed opening, timing, how they want to structure this. Obviously, you have the Powell opening a year from now. The BLS, is a different story. It has more of a political feel to it. You were talking before about the Ray Dalio tweet over the weekend that he would have fired the BLS commissioner, and I think there is an argument to be made about reform of the BLS and the jobs survey in general. But the problem is, in Republican circles especially, it's been talked over the years of manipulation. That makes it very partisan and political, when the fact is, anytime there are problems in government, a lot of it can be attributed to, sorry to be blunt about it, but incompetence and inefficiencies. And that there is a need for improvement in the processes, especially at BLS. But it's gotten caught up in the political narrative of the day.
And we may be hearing about who the next potential appointee could be. Brian Gardner of Stifel, thank you so much for being with us. And we are expecting to hear both that as well as a potential candidate for that open Fed position as early as even today.
Yeah, the president said he was going to name the names this week. What's interesting when it comes to BLS, Wall Street Journal has a report out today that is saying in recent months it's faced staff shortages brought on by a hiring freeze from Trump in January. So maybe this new commissioner could actually convince the president, lift the hiring freeze. Let's get more analytical thinkers in the BLS, statisticians, and maybe we can get a sharper read on the labor market.
Which a lot of people in markets would welcome. Watch this space. Coming up, Tom Shapiro of GTIS Partners on the affordability problem in the housing market and how to actually fix that. This is Bloomberg. A big day of gains yesterday, building on those this morning as people look ahead to AMD earnings, as well as all the upward revisions and a potential rate cut. We were hearing from Goldman Sachs that potentially the Fed could cut even 50 basis points as soon as next month should the economic data roll over. Russell 2000 futures up about 0.5%, 2 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, some more earnings to get through this morning. We heard from the beer maker Molson Coors, a cut to their net sales. Two issues for them. One, just in general, volumes have been lower. Less people have been buying their beer products. And two, because because of tariffs, aluminum cans are going to be costing more for them. So it's an issue for margins. So net sales they see is dropping between 7 to 10% for the year. Previously, their estimate was 3 to 4%. We also got earnings this morning from Caterpillar, often seen as a bellwether. It was a miss when it comes to their profit. Now, the tariffs, they are taking a hit there, up to $350 million in the quarter. And the other issue for Cat is they've had to lower prices. Their margins were really hurt in the quarter, so shares down 3%. Now, to the upside this morning, we heard from Pfizer. For them, it is an upgrade to their outlook. Now, they say that's not thanks to COVID products, because those have been waning in popularity. So they made up elsewhere. They've been cutting costs. They also say they've seen a positive impact from a weaker dollar. And they're yet another company to cite the positive impact of changes to tax policy. So those shares up 2%, Lisa.
Thank you so much, Danny. On our radar this morning, President Trump saying he would be, quote, substantially raising the tariff on Indian exports to the United States, citing India's purchases of Russian oil. New Delhi slamming the move as unjustified and a real question around what they could do other than really shifting some of their global alliances.
Well, what's interesting here is I do think the administration is looking at India and they are trying to kill two birds, one stone. One, we want to make sure that they get to some sort of trade agreement. So we're going to put some pressure on India when it comes to their imports of Russian oil, which, by the way, then they're refined and they sell back to the rest of the world and have been making a ton of money since Russia's invasion of Ukraine. Two, they are trying to end this war in Ukraine. You have Steve Witkoff, the president said is going to be going to Russia this week. He has this self-imposed truce deadline for Vladimir Putin to meet this Friday. And one thing that continuously fuels Putin's ability to fund this war is the continued exports of things like crude to India, to China, to Brazil. But it's much easier to put pressure on your friends.
If I were Tom Keene right now, I would say, let's rip up the script, because I've been looking at the price of oil and it hasn't materially increased on the heels of this, even though potentially this could lead India to bid up prices in other places. And this comes in the heels of Saudi Arabia increasing production dramatically and OPEC Plus doing the same. I just wonder how much breathing room that's giving President Trump to go much more aggressively against Russia, trying to curtail some of their oil exports.
A tremendous amount. I think Saudi Arabia is looking at the picture right now and saying, we're going to go after market share. We're going to go after the cheaters that we have seen over the past couple of years when it comes to them pulling back supply of the market. At the same time, they're doing it at a time where they're currying a ton of favor with this White House.
Yeah. Meanwhile, the Trump administration providing guidance ahead of its tariff rollout, posting a notice saying expanded reciprocal tariffs will not apply to any products loaded onto a vessel for transport into the U.S. before 12:01 a.m. Eastern on Thursday. Got that?
So this is why this is actually interesting, because the U.S. Customs and Border Protection actually put out a notice. So anytime Trump puts out a truth, a letter saying that he wrote this partner, the tariff rate is going to be this, you actually need an executive order and then the Customs and Border Protection to put out the guidelines of what those rates are going to mean in actuality in terms of collecting the tariffs at the border. And now they did this, which is why this feels very real. In less than 48 hours, these rates are going to hit, which is why it's going to be even more challenging for the likes of India or Switzerland to get a deal in time for those rates to be lowered. So even if they were to get a deal, potentially there's going to be a week or two where they have to deal with these higher tariff rates.
Do you have a sense of the timing of how long it takes just to update the systems, the customs systems and the entire infrastructure to process some of these tariff rates in real time?
Well, it takes at minimum a week, because we saw the president come out with that executive order last week and said this is going into effect August 7th. And everyone said August 7th is a new deadline. Maybe for certain countries, one or two, but for everyone else, these rates are set and they're going into effect in less than 48 hours.
Sticking with politics, Texas Governor Greg Abbott ordering the arrest of Democratic lawmakers who left the state to block a controversial vote on a new congressional map, saying in a statement, quote, Texas House Democrats abandoned their duty to Texans. Just really ramping up the pressure in that political fight.
Absolutely. So two things we should know. One, they don't carry any criminal charges. And two, they can't be enforced across or state lines. So basically, if you're hiding out in Chicago, New York, or California, you're not going to get arrested. There's a lot of noise surrounding this, because now you have Governors Newsom, Hochul saying they're going to do the same. The signal from this is that there's going to be a tremendous amount of politics regarding all of this ahead of the 2026 midterm elections. And everyone is trying to do whatever they can on the margins to grasp another seat or two, given how tight we've seen the House seats and those margins are.
One thing that a lot of people have been looking at are the main issues that are going to be discussed. And one of them has been the affordability of housing. And turning to the housing market, tight supply pushing up home prices with the average 30-year mortgage remaining above 6.7%. Tom Shapiro of GTIS writing, affordability is the biggest issue, near the worst point since the 1980s. But incomes should grow faster than home prices over the next few years. Tom joins us now. And before we get into the nitty gritty, I'm just curious, with all of the discussions right now about housing affordability, why haven't there been more builders coming out and actually creating that supply in areas that didn't see the boom in building, like the Sun Belt?
Well, the issue has been affordability, which is right now people are spending 40% of their income on housing, which is just way too high. Also, I think consumers very much have been concerned about the things you're talking about tariffs, about the economic outlook, about their jobs. It is the largest purchase that anybody makes in the United States, so they're quite cautious before they make it. So we're actually seeing new home sales down 13% right now. Existing home sales are down 3%. And given, they're on a positive side, there hasn't been a ton of supply because 72% of mortgages are locked in under 5%. And to get a new mortgage, you're close to 7% today. So obviously the cost of just a small move up is massive. So that's really helped and why we haven't gotten into a more GFC type situation right now. But the issue right now is affordability, and it's something that has to happen. So a couple things can obviously change that. Incomes can go up, which hopefully we'll start to see. Prices can come down, or mortgage rates can come down. So any of one of those or all of those together will help the affordability issue. But until that happens, it's going to be a slow selling season.
And Tom, we have seen prices come down, particularly in certain regions that had gotten really built up and seen really a rapid price appreciation in the direct aftermath of the pandemic. I'm just wondering how much further it would have to go to right size the affordability question, all else being equal. If we don't see a huge increase in incomes and we don't see a huge decrease in mortgage rates.
Well, you'd have to see a very large decrease, because if you want to get back to what real affordability should be, it should be in the mid-30s, what people should be spending of their income. So you're talking about a 10% decrease. So that is probably not going to happen. And that's really because of the supply picture that I painted for you. There just isn't enough supply to do that. People just aren't putting their homes back on the market. And that's really helped to prop up because you're not seeing the existing homes. While the inventory's up, certainly from last year, it's just not where it used to be. So I don't think we're going to see that happen. So hopefully there'll be some combination of all the factors that will help us get back to a more normal selling season.
Given that it's been challenging for individuals to get on the property ladder in terms of buying a home, what has that meant for the rental market?
Well, it's been quite good. And so a lot of people have been moving to renters. And just to give you a number, if rates drop to 6%, we'd see 160,000 renters move over to be buyers of homes. So the rental market in a lot of areas, particularly the coasts, have been really good. We're seeing San Francisco prices for rent are up about 6.8%. New York's up about 3.5%. It should be the same in other markets like the Sun Belt, which have had good economic drivers and good job growth. The issue has been the supply. They were just really oversupplied. If you take a market like in Austin or Nashville or Charlotte, those are some of the best markets from a job growth perspective. The issue is every developer got the same memo, and so everybody built. So Austin, for example, was the best multifamily market in the country. It's now the worst, although it's seen very positive absorption. So hopefully that will right size itself, but it'll take a year or two before that absorption happens. So right now, from an investment perspective, we're much more focused on the coasts than we are on the Sun Belt.
There's been a lot of concern about what tariffs would mean for the construction industry, but at the same time, you're talking about a flush of money trying to go into some of these markets. What has that meant for the home building industry and construction?
Well, that's a pretty interesting thing. So you would assume, given the issue with the labor market, given the immigration issue and given the tariff issue, you'd assume costs would be going through the roof. They actually have been really moderate. Costs are muted up maybe about 2%. And that's because there just isn't a lot of building right now. So the trades, the people are, who actually do the framing and the electricians and the plumbers are getting much more aggressive when they're bidding contracts. So if you're an electrician and you need to win 10 contracts a year and you're bidding 40 contracts, you're going to bid them pretty wide for a very high profit margin. But today, if you're only going to get 15 that you bid on because there's just not a lot of jobs out there, you're going to bid a lot more aggressively. We've seen, not so much in multifamily because we're not building multifamily, but for example, in our industrial portfolio, we're actually seeing tremendous cost decreases throughout our portfolio, 5, 10, even 15% decreases because of this very issue. So the whole concern about tariffs and raw materials going up, which they have, has not really flowed through to the cost side.
Tom, before we let you go, you said you like the coasts in the United States, and I have to bring up some of the political proposals that we've seen in places like New York City, this idea of trying to cap the rents that potentially could get passed along and other policies that are considered builder unfriendly. How much does that or will that shape your view of how attractive of an investment that region is?
Yeah, very much so. I mean, the issue, of course, is that if you cap rents, your expenses aren't capped. So if municipality or city says you can't raise the rents, they are still going to raise your property taxes. Your utilities are still going to go up. Your insurance costs are going to still go up. So it is something we look at a lot. Those, of course, are on the stabilized unit. So not all properties have a lot of rent stabilized. So we're definitely focused on that. When you look at San Francisco, all smaller buildings have a cap of 60% of CPI until the tenant moves out. So it's something you have to look at, because if you have tenants that are going to stay in place and your costs are going to go up and you can only raise your rents by 60% of CPI, that's a huge issue. So it is something we very much look at, but of course it's not across the board. It's really on the stabilized units. So you have to be careful about what percent of stabilized units. The last time this happened in New York, when they capped and actually stopped allowing rent increases for stabilized units, it was a complete disaster. So many properties went into foreclosure. It's a really terrible thing. Of course, politically it sounds great. We're going to stop those bad landlords from raising rents. But the issue is then there's no capital that will go into these buildings. And then what happens is you end up with a lot of units that actually just sit fallow and people don't rent them out because it's just not worth it. So it is a really bad policy. And so, of course, affordable housing is a huge issue and something that we absolutely have to address. We just have to find a better way to address it than just to cap or stop rent increases.
Tom Shapiro of GTIS Partners, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The White House is preparing to ramp up pressure against big banks over perceived discrimination against conservatives and crypto companies. That's according to the Wall Street Journal, which reports the order would direct bank regulators to investigate financial institutions and fine lenders that drop customers for political reasons. Meanwhile, the State Department will require bonds up to $15,000 for some tourist and business visas under a 12-month pilot program. The bonds are targeting countries with high overstay rates or weak applicant screenings. There won't be an option to apply for waivers, but officers may waive bonds for urgent humanitarian needs or other limited circumstances. And after surging 23% yesterday, American Eagle shares are rising again today after President Trump said the company's Sydney Sweeney ad is the, quote, hottest out there and that its jeans are flying off the shelves. It's not clear yet whether the ad, which controversially celebrates Sweeney's genetic traits and her genes, is actually convincing shoppers to buy American Eagle clothes. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. It might not be convincing people to buy jeans, but it is definitely convincing people to buy the stock, which raises a question. Isn't basically any news, any publicity, good publicity?
Yeah, and now they're being talked about every single day, even by the President of the United States from the Oval Office. I don't know, when was the last time you actually heard anyone talk about American Eagle?
Yeah, and that's true, actually, even with teenagers at home. And we are seeing meme stocks reverse. So this really reigniting some of the interest around those specific names. Up next, Fed rate cuts in focus.
I think the Fed probably will be behind the curve because the tariffs create so much uncertainty about what's going to dominate. I think the prospects are pretty good that the Fed's going to cut rates later this year.
Amanda Lynam of BlackRock joining us next. This is Bloomberg Surveillance. building on yesterday's gains as people take a look at earnings and ignore the noise that is what we see in the tariff space. What we are seeing is gains of about 0.25% on the S&P 500, a little bit of dollar strength, just kind of meandering around that 115 mark on the euro-dollar cross, and yields marginally higher, 2 basis point increase on the 10-year and pretty much across the curve, 4.22%. Focused on the bond market, under surveillance this morning, Fed rate cuts very much in focus.
I think the Fed probably will be behind the curve because the tariffs create so much uncertainty about what's going to dominate, the risk of inflation or the risk of growth. I'm worried that we're going to be in a sort of stagflationary environment where we're going to have both higher prices and a weaker economy. I think the prospects are pretty good that the Fed's going to cut rates later this year. Whether it turns out to be September or not really is going to turn out to depend on the data.
Here's the latest. San Francisco Fed President Mary Daly says the Fed may cut rates more than twice this year if the labor market continues to show signs of weakening, saying, quote, "I was willing to wait another cycle, but I can't wait forever." Amanda Lynam of BlackRock joins us now. Amanda, wonderful to see you. Thank you for being here. How much are we looking at the Fed rescuing markets from weakness before the weakness happens?
Good morning. Thank you for having me. I think that's exactly the point. The reason for the rate cuts, in my view, is more important than the timing. So our expectation is that the rate cut is most likely in the fourth quarter. Yes, the risks are skewed till September, but why are they cutting? Are they cutting because the growth backdrop is deteriorating, or are they cutting because inflation is cooperating? It's looking more and more like they would be cutting because the growth backdrop is deteriorating. I'm not sure that's a great outcome for risk assets. It does feel like the market is preempting this a bit. In our world of corporate credit, spreads are still resilient. There's some differentiation under the surface. But I actually think the market is looking through this a bit. And the reason I say that is you've had folks like Beth Hammack last week talking about how we're not that far from neutral. So leaving aside the timing of the cutting, and if we focus on the reason and actually the scope for the depth of the rate cutting cycle, I'm not sure that there's that much relief in train absent a sharp downturn in growth.
Why did people shrug off the labor market report on Friday and the revisions that were incredibly negative and caused the firing of the BLS chief?
What I think it is that Chair Powell almost went out of his way in the press conference to talk about how he's emphasizing the unemployment rate over the number of payrolls gained in any month because, as he noted, the break-even rate of payrolls growth is slowing because immigration is coming down. So if you look at, we were at 4.1% as of the July FOMC. We're now 4.2, edging up on 4.3. Chair Powell characterized that 4.1 as being close to maximum employment. So yes, the revisions were very large, not unprecedented, but large. But actually, if you look at the unemployment rate, with inflation still above target, I still think there's actually some tension in that dual mandate. And so it's not, for me, a base case or very clear cut that they will cut in September, because I think if you look back to the July FOMC, Chair Powell made a point to emphasize that unemployment rate. And I think that's part of that undercurrent. When the market had a bit of time to digest it, focusing on that, I think you could come up with a different path. But I think, to be clear, the direction of travel is very clear. Rates are coming down. It's almost a moot point. Is it September or October? I'm not sure it quite matters.
Well, the market's pricing a 90% chance of September. What would it take you to say it is September?
I think if you started to see some cooperation in inflation, I think that could get you there. That actually that tension on that price stability side of the mandate could ease up a bit. And then, of course, we do have some more data between now and then. So if you start to see some real continued weakening in the labor market, we've already seen weakening, but if that is persistent, I think that could really push them.
There's a lot of politics surrounding right now the data and the Fed, and the president's going to have a chance to now. He's going to put a new name in for the BLS commissioner, which he fired, and Adriana Kugler, the Fed governor, is supposed to step down in January. She resigned early. Are you concerned that all of this is getting politicized and there's no independent credibility?
Our conversations with investors are very much focused on the fundamentals. So I think there is a lot of noise in the background, but actually top of mind in our conversation is how are companies navigating this, and what are the levers that companies can pull going forward if the growth inflation mix becomes more challenging as we expect. What I find striking is that second quarter earnings have given us some data points that companies in some instances are lowering their estimated impact of tariffs relative to what they communicated in the first quarter. Certainly not every company. There's a lot of dispersion. But if you look at the myriad of operational levers that are available to companies to navigate this, that could include things like changing product mix, accelerating accelerating cost cutting in other areas. There's actually a fair amount of levers. It kind of reminds me of 2022 when there was a swift rate hiking cycle. There were imminent expectations for a recession. It didn't materialize. I'm wondering if the several quarters of above trend growth from 2023 and 2024 actually built up some cushions in the corporate sector, and there's resilience there.
There's also the one big beautiful bill, and we haven't talked about it as much as maybe we should have in terms of the ramification for companies. But the Wall Street Journal put out a story just highlighting the free cash flow and how much it's increased on the heels of this particular piece of legislation. How much is that buffering a lot of companies in ways that might have been underestimated going into this?
It's a great point. You noted a company earlier this morning that I think raised their guidance related to that. We also saw earlier in this earnings season a telecom company do the same. So I think it's a great point. The two-sided risks are very real. It's not just about the downside risks to growth and the tariffs, but it's also about the deregulation. Actually, M&A, strategic North American M&A, is running at the highest pace since 2021 year to date, and we know 2021 was a banner year for strategic deal making. So I can't help but think that under the surface, and to the noise point you mentioned, Annmarie, there is a fair amount of corporate confidence that is coming through. And I think that is why we are very mindful of two-sided risks.
At the same time, it's priced in. Right. And you're looking at very tight spreads. This is all kind of priced to perfection, a number of people have mentioned. Where do you still see value, given that, yes, there is a lot of positivity, but it's also something a lot of people have recognized?
Right. I would say if I had to pick one area, it would be selectively moving down in credit quality within corporate credit. So if an investor is confined to IG, we like that BBB pocket of the cohort. If there's a more flexible mandate, we like moving into the high end of high yield. You make a great point. There's not a lot of scope for absolute spread tightening at current levels. Episodes of widening are short-lived. The dips get bought, so to speak. But similarly, I think the bar for a sustained sell-off in widening in credit spreads is actually quite high. And of course, as you know, the yield-based demand is a very real technical. So we're pretty constructive on corporate credit risk. That said, not everything is participating. CCCs are still lagging. I think that's appropriate. I think that reflects discipline in the market.
Yeah, maybe actually a market and not necessarily something that's bad, that's propped up by a particular policy. Amanda Lynam of BlackRock, thank you so much for being with us as we do plow forward for ISM services at 10 a.m., the trade balance before that. And then later this morning, or later today, we do get bond auctions at a time where there's a real question of how this government is going to finance itself. And that's going to be an increasing conversation going forward with the revenues coming in from tariffs, but also with the Treasury Department playing around with a couple of different options.
I remember the President of the United States talking about it, saying that we should be financing with lower rates because of how much they are paying to pay off their debt. Remember, the net interest of paying off what we borrow is now the biggest line item on the U.S. budget, bigger than the defense budget.
Yeah, unfortunately, a lot of people would point out it doesn't tend to work like that a country that is borrowing more gets to pay a lower rate. Coming up, Eric Johnston of Cantor, Fitzgerald, Dan Ives of Wedbush after yesterday's Palantir blowout earnings, Dana Peterson of the Conference Board, and Flexport CEO Ryan Peterson. That's the next.
Our markets are the envy of the world.
You do need tech to keep delivering. Luckily for us, they have been delivering.
You've got, I think, a little bit of froth showing up.
Meme stocks are back. Crypto's rallying. That's what I'm worried about.
There's going to be continued volatility. Use it as an opportunity to buy the dip.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance in the third hour, heading into another day of tech dominance after Palantir's earnings and talk of astonishing AI impact. Getting some trade data and bond auctions as investors wonder how far this rally can run. A real focus now on some sort of dip that buyers are hoping to come into, but hasn't yet materialized.
Exactly. And a lot of them, like Morgan Stanley, is basically saying when you see the dip, that is a time to buy. And they're thinking that really the market just bowed out April 2nd, and we're not going to see those lows ever again. And right now, we are just shy from a record high, which the president was leaning into last night, obviously liking what he saw in terms of the rebound after that really weak labor market report, so weak that he fired the BLS commissioner, and that is something we are still waiting on today. And this week. It's not the data I'm really looking out for. Who is he going to put in the chair for the BLS commissioner? And also, who is he going to put in the chair for Adriana Kugler, who's resigning sooner than expected.
What's fascinating to me is you have all these headlines that are incredibly dramatic. The idea of a nearly unprecedented firing of the BLS chief. You also have a potential new seat on the Federal Reserve that will get filled. All of these things that could be very market moving, not to mention what we see on the trade side. But it's a Teflon market. We saw Nvidia, Meta, Microsoft reach new highs. We saw more than 80% of the S&P 500 end the day in the green yesterday with the biggest one-day rally going back to May. Is the Teflon market justified by Teflon earnings? And that's something that a lot of investors seem to be kind of battling out.
And I think it really depends on what part of the market you're looking at. As Jack Caffrey was talking about, there's 7, then there's 493 companies. And the 7 that are spending on AI, that are going out of their way and are doing so and saying we can do this and have this kind of revenue growth with less people. But how long can that last?
Yeah, right now we're seeing in markets continuing to build on gains as people look ahead to trade data that we get out in about 28 minutes time, as well as ISM services. Do not miss that. Up about 0.25% futures for the S&P 500. A little bit of dollar strength, 115 on the euro dollar cross, and 10-year yields up about 3 basis points. That's sort of where we are around for the entirety of the curve, 4.22% after the rally that we saw at the end of last week. Coming up this hour, Eric Johnston of Cantor Fitzgerald as stocks extend their rebound. Dan Ives of Wedbush as Palantir's blowout quarter pushes shares toward record highs. They are up more than 500% over the past 12 months. And Peterson of the Conference Board on the state of the U.S. consumer. We begin this hour with stocks higher on the heels of strong earnings and rate cut bets. Eric Johnston of Cantor Fitzgerald writing this: we continue to believe that equities will experience a shallow short-term reset. However, our 6 to 12-month outlook remains bullish. Eric joins us now. Eric, you are one of those who does see some sort of pullback. We have seen this from Morgan Stanley. We have seen this from Bank of America. We have seen this from Evercore ISI, waiting for the dip to buy. How much can we see a dip if everyone's expecting it and waiting to swoop in?
That's a great point. I mean, I don't think the dip is going to be that significant, but we do have, significant headwinds in the form of tariff revenue over the course of the next few months. We saw some of the impact on Friday in terms of the payroll report. But the bottom line is the tariff rate likely going to be in the 17 to 18% area. That's likely going to be somewhere around $600 or $700 billion a year of tariff revenue. And so over the course of the next few months, you're likely going to see the inflation rate start to tick higher, and you're likely going to see some very subdued economic growth. And you've also have a market that it's had a big run, right? We've had overbought conditions, and there's been this flurry of buying in lower quality, high short interest names, which essentially, has kind of given some exuberance to the market, which could result in a little bit of a pullback. We also have seasonal challenges. But again, don't think the pullback is going to be that significant, and I think it would be a buying opportunity.
Well, Eric, this is really the conundrum for so many investors. Just because there are evidence of froth doesn't mean that there's going to be some sort of crash, especially when there's fundamental underpinnings to it. Are there any signs that you see where there isn't a fundamental justification for the gains currently being had?
So I think the market is discounting into 2026. I think that's really what's going on, because the 2026 outlook, I think, is very, very good. And you have, and I can kind of go through a few of those, but I think the market is saying, look, this hiccup that we're seeing in the economy, right? GDP growth was really about 1% in the first half, likely going to be somewhere around that in the second half. And it's mostly being caused by the tariff revenue I just mentioned, that is really a short-term factor. We're seeing a small slowdown in growth, and it's going to result in a Fed cut cycle that is going to begin. And we're going to see a lot of tailwinds in 2026. So whether the Fed begins cutting in 2025 or whether it takes till May of 2026 when we have a new Fed chair, this cycle is going to begin. And we're going to have this dynamic where the Treasury is trying to get the entire curve lower, and also the Fed working in concert to get the entire curve lower, because that's what the administration wants. That's going to be a very powerful force in the face of an economy that we don't think goes into recession. And at the same time that that's going on, you have the other sort of economic longer-term growth tailwinds from the data center build-out, from many of the investments that have been announced from overseas that are going on domestically in terms of onshoring, and from some of the deregulation that has been announced but takes time to filter through the economy. So that backdrop is very favorable. And I'll mention one other thing, which is that corporate earnings. So AI so far really hasn't had that much impact on the efficiency of non-tech corporate America and margins. And that's coming. And whether that starts in 2026, maybe the back half, you're likely going to start to see that very soon. And that should be a very positive longer-term backdrop for corporate earnings. So I think the market is just discounting what's going to be happening starting in 2026.
Eric, and you talk about the fact that President Trump recognizes this is his market and his economy now, which should result in pro-market policies and a de facto Trump put. At the same time, many people are saying that he's undermining the own credibility of the United States with the continuous jawboning of Jay Powell, but also the firing of the BLS commissioner. Do you think that is undermining the potential credibility of the next few labor market prints?
What I would say is that I don't think the market is focused on that. So while I understand, the questions about Fed credibility, Fed independence, and that this goes against the norms that we've seen for a very long time, and also, of course, around the labor chief and the statistics and the administration getting involved in that. But I think that's not what the market is going to be ultimately focused on. And if the result is that the Fed is a little bit less independent, but we have extremely accommodative policy, that is going to essentially overwhelm any concerns around Fed independence. Ultimately, markets like cheap money, and they like when you have higher nominal growth combined with lower rates. And so, the way that we get there, while many people, may not like it, and it may not be what has happened historically, the benefit to asset prices, I think, is going to overwhelm those other factors.
You also say the administration has levers to counter economic or stock market weakness. What else do they have? They already have the one big beautiful bill, the tariff story almost behind them. They really want to see interest rate cuts. What other levers can they pull?
So there's things that the Treasury can do around moving issuance to closer to the front end of the curve. There's things that a Fed chair can do around implementing QE or yield curve control, not being talked about right now, but that's something that can be done. We have, from a tariff perspective, we have these rates in place. Some of them are related to fentanyl, things that can show improvement. And so, if we were to get into a weaker market, could some tariff rates be lowered? That's certainly possible. Could there be some fiscal stimulus? There's a number of things that can be done to counteract any sort of economic weakness. And I think there's a lot of levers in place, and those include tariffs, which are now at very elevated rate. You look at a 20% tariff on China related to fentanyl. Maybe that outlook on fentanyl gets better and could be used as a reason to lower tariff rates there. So a number of things.
Eric Johnston of Cantor Fitzgerald, thank you so much for being with us this morning. Right now, let's get you an update elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Switzerland's president and economy minister are traveling to Washington today to discuss tariffs, even as they have no formal invite from the White House to meet with President Trump. The Swiss officials plan to present a more attractive trade offer in an effort to lower a 39% tariff imposed by the Trump administration. Meanwhile, Texas Governor Greg Abbott has ordered the arrest of Democratic lawmakers who left the state to block a vote on new congressional maps. Abbott saying the lawmakers abandoned their duty to Texans and that they could potentially face forfeiture of their elected office. The tensions now have governors of other states also looking to redraw maps. And Celtics minority owner Steve Pagluka has offered to acquire the Connecticut Sun and move the WNBA team to Boston in a deal that values it at $325 million. Sources telling us here at Bloomberg the investment group led by Pagluka plans to spend $100 million to build the team a new practice facility. Quite the sweetener. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls, plus Dan Ives of Wedbush on Palantir's blowout quarter and the 500% gain in the shares over the past 12 months. That's next. This is Bloomberg Surveillance.
And as we've worked our way through earnings season, to some extent, your biggest and best news has been less about the earnings and more about the capital spending boosts that so many of these companies have been talking about. That remains sort of, if you will, the trillion-dollar question in the markets of how this spending will ultimately turn into higher margins, better growth rates, and ultimately returns to shareholders.
That was Jack Caffrey of JPMorgan. We are getting some news on the next head of the Federal Reserve. President Trump speaking with media this morning, saying that Scott Bessent, the current Treasury Secretary, declined consideration to be the Fed chair, wants to stay where he is, Annmarie.
He wants to stay where he is. The Treasury Secretary says this numerous times, including to us. And he told us a few weeks ago that he was part of the decision in terms of the decision-making process, almost taking him out of the running. And every time you talk to him, he says, I have the best job in Washington, D.C. The president went on to say he doesn't love Scott Bessent, though, and he wants to stay where he is. So it looks like Bessent's not going to be the next Fed chair.
Yeah, so one of the Kevins or someone else maybe. Right now in markets, you are seeing equities, futures bleeding higher on the heels of really earnings and shrugging off some of the policy concerns or uncertainty. People are sick of hearing that, saying that, up 0.3%. For S&P futures, you can see the dollar just gaining slightly against the euro, 115.40, and yields marginally higher, up 2 basis points on the 10-year. Crude, interestingly, lower by 1.6%, with the president saying also that if the price goes low enough, maybe Vladimir Putin will stop the killing. Time now for the morning calls with one stock in focus, Palantir. First up, Deutsche Bank upgrading the stock to hold, citing the company's, quote, excellence in artificial intelligence. Those shares up 7.3% this morning. Next up, Piper Sandler raising its price target on Palantir to $182, saying it is a one-of-a-kind growth and margin model. And finally, Bank of America raising its price target on the company to $180, saying it is the best in class for AI. Let's stick with Palantir as its shares do surge after reporting a 48% increase in revenue for the second quarter, citing the astonishing impact of AI technology on its business. Mandeep Singh of Bloomberg Intelligence joins us now. I am so glad that you are here, Mandeep. Can you explain to us, aside from the government contract model for Palantir, where the growth is going to be and what kind of astonishing performance they've been seeing?
Look, when it comes to Palantir, clearly they are applying large language models to applications. So what I mean by that is if you have big data, you can actually call, a ChatGPT API or an Anthropic API and build a customer service use case around it or a supply chain use case. And that gets reflected in the U.S. commercial business, which they expect to grow 85% off a low base, but very impressive growth. The thing that I don't get is their market cap now is equal to Salesforce and Adobe combined. Think about it. Salesforce and Adobe make up $60 billion in revenue annually. Palantir is a $4 billion annual run rate company, growing at 50% this year. I don't think the growth rate will stay at 50% for the next 8 quarters, so it will taper. But how do you kind of wrestle with the fact that, the valuation of these two big market cap companies that generate $60 billion is lower than a Palantir, which is close to $400 billion. I think that's the big dislocation, that earnings and free cash flow can they cannot keep up after a while. And to me, that is where there's a disconnect. They can win government contracts. They have a lot of referral business. But at some point, the numbers just get way ahead of themselves, and the valuation right now is so stretched that there's no way they can grow into the valuation.
But they did surpass $1 billion in quarterly revenue. So what are they going to do with all this cash?
Well, I mean, look, again, this is a small company when you compare them to enterprise software makers. That's why I use Salesforce and Adobe as an example, because there are maybe 50 companies with over $10 billion revenue run rate in enterprise software. So there aren't a lot. I mean, it's one thing to get to $5 billion in revenue. It's a completely different ballgame to get to $15 billion in software revenue. And that's where a lot of the companies get acquired because their growth slows. So to my mind, Palantir was there even before the AI wave happened. They did get a lift by, integrating large language models, but it's not as, good of a compounder as your cloud companies are. That's where ServiceNow, Salesforce, Adobe, they've compounded over the years at 20% CAGR. I just don't, I expect a lot of pull forward here, and that's where I'm not buying into the valuation, and that's where you didn't even get a 10% lift. They did a beat and raise by 10%. You didn't get a 10% lift in stock price. There is, I think, some level of skepticism around where they are trading in terms of multiple.
Mandeep Singh, I love the passion. Mandeep Singh of Bloomberg Intelligence, and the yin and the yang. For the yang, Dan Ives of Wedbush raising his price target in Palantir to $200, writing, "We believe in the next few years, Palantir has the potential to be $1 trillion dollar market cap as the AI revolution takes hold." Dan, I'm sure you were listening to what Mandeep was saying about how there is no way for the valuation of Palantir to be more than the combined market caps of Salesforce and Adobe. They can't grow into this quickly enough. What is your counterpoint?
Yeah, I wonder what Mandeep's going to say when it's $1 trillion company in the next 2 to 3 years. I mean, look, my view is the reason it's the messy of AI, they are owning the use cases on the software side. And I think the street continues to underestimate where this growth is going. And I believe over the coming years, Palantir, it's going to be on that Mount Rushmore of tech. And that's why investors are recognizing it. And we believe, I think this is just the beginning of this AI revolution, and Palantir is the gold standard.
Dan, this has been a company deeply associated with the Defense Department, deeply associated with the U.S. government and various contracts. How much are they able to parlay that into the public sector? How much does this remain very much a company intertwined with the U.S. government?
Yeah, it's a great point. Look, I mean, if you go back to their history, their roots, it was government. But now it's kind of the 1-2 punch because they're getting massive deals on the government, on the federal side, because when it comes to AI, who's the first call? It's to Karp and Palantir. Then on the enterprise and the commercial, you're basically starting a whole new business. So that's why this is such a unique company. And I understand what Mandeep's saying, but my whole view is, look, the bears, when they're sitting in the caves, they can see AI in the spreadsheets. And I think that's how they've missed this move. And I think they're going to continue to miss it on Palantir.
Dan, when it comes to Palantir, though, the company is deeply connected to Republican politics. Does any of this change if there's a changing of the guard in Washington?
Yeah, look, I think that's something you got to cross that bridge, when they come to. I do think that the technology continues to stand above the rest. I think, because I can tell you all my time in D.C., the agencies, that's what they're focused on. And look, that's why Palantir has been elevated to a special status. You look at Oracle, you look at Microsoft, who they partnering with, Palantir. And I think what's essentially happening here is it's revolutionizing software. But when it comes to AI revolution, we can talk about all the hyperscalers and all the growth that we saw over the last week or two in earnings. The use cases, the golden goose is Palantir.
When it comes to where are they looking outside of the U.S. government, could you see them doing more contract work for other governments?
Well, yeah, especially Western governments. I mean, obviously, Europe is basically nowhere, right? I mean, just given the privacy, and Karp's talked about that. But I think going forward, as more sovereigns start to head down this path, especially in the Middle East, Palantir is going to play a huge role. And I think that's something you saw even on Trump's trip. Of course, you had Jensen there, but Karp's there because when it comes to the use cases, Palantir, they're in, look, I can tell you 25 years covering tech. I mean, that quarter last night, it's a Hall of Famer, right? I mean, that's when you print that press release out and you can hang that in the Louvre.
Dan, so you see Palantir as a big winner, potentially joining the $1 trillion club. But we've seen another slew of big winners when it comes to Meta, Microsoft, as well as others that we have seen come out, NVIDIA chief among them. Who are the big losers in the tech universe that we have seen so far or that we may see in the upcoming weeks?
Look, I think some of the losers, Cisco, you could argue, is maybe on the wrong side. Some of the legacy players like Dell. Look, for a while, like AMD was on the wrong side, but I think AMD is on the right side, right? That's why they're part of the Ives AI 30. I think consulting firms, you see what's happened to Accenture and others. Look, it's a fork in the road. And I think when it comes to what we're seeing in tech, there's an elite group of companies that's taken the lead. And look, and that's why Salesforce has been a lagger, and I think Salesforce is going to get there, but it speaks to you're either in or you're out. And this AI party we talk about, it was 9 p.m., it's now 10 p.m., it goes to 4 a.m. And everyone wants others to join the party. They want Apple, do an acquisition, join the party. Look at AMD, they're going to get into, and then that's how investors are viewing it. And on the dance floor is Carp, Jensen, Nadella.
Well, when it comes to AMD, they report earnings after the bell. What are you looking for?
Get the popcorn out. I think Lisa Su is just starting what I believe is going to be just a massive phase of growth when it comes to AI. They're going to start, in terms of the innovations that we're seeing, they are going to start to get a big piece of this pie. And from a valuation perspective, we think this could be, stock well into the twos.
All right, crack out your Red Bull, your Celsius, Dan Ives, because we're going to be dancing evidently until 4 a.m. Dan Ives of Wedbush, thank you so much for being with us.
Well, especially if that Celsius is a high noon.
Yeah, well, that's going to be a different kind of party. Look, I think a lot of people are looking at how far can this run. And this is so difficult to really understand because people have underestimated just how far some of these artificial intelligence gains can go. And every major company out there, and I'm not talking about tech companies, has an AI group devoted to working on how you can integrate artificial intelligence and large language models into the everyday workforce. This is coming, it is coming, and it is getting implemented.
And how high is the bar for some of these companies? AMD is one of the best performing stocks in the semiconductor sector in 2025. Now, does this company have a target on its back because of that? And at the same time, the president speaking to the American media today talking about how semiconductor tariffs are coming down the pipeline. That's a challenge.
Yeah, coming up, we're going to get a sense of the trade situation with trade balance data. Dana Peterson of the Conference Board is here to react. Coming into Tuesday with futures building on gains from yesterday. Yesterday was the biggest one-day gain going back to May. We also are getting some headlines as President Trump speaks, particularly having to do with Treasury Secretary Scott Bessent, who had been said to be in the running for potentially leading the Fed. President Trump saying that he is asked not to be included in that roster, as he does like where he is.
Yeah, he said, I asked him last night, is that something you want? Nope was the answer he got from the Treasury Secretary. I want to stay where I am. And we basically heard that from the Treasury Secretary a number of times. Of course, he was very diplomatic, saying I'm the best job in Washington, D.C., but I serve at the pleasure of the president, and I'll do what he wants to do. But at the same time, Treasury Secretary made it very clear he was part of the decision-making process, not actually in the process in terms of the individuals the president could pick from.
Yeah, so not particularly surprising. Also saying, talking about a potential meeting with Xi Jinping, as well as going after the banks, and we will get into that in 1 second. Right now, we are getting some data, trade data, coming across the tape. Bloomberg's Michael McKee has the numbers. Mike.
Well, the president's going to be happy about this number a little bit, I guess, because it comes in lower than anticipated and certainly down from last month. These are June numbers for trade. The trade balance is a negative $60.2 billion. That's down from negative 71.7. Now, we saw this in the advanced numbers, but this is the goods trades balance added in with services. And services, usually we have a surplus. The imports number is down by almost 4%, negative 3.7%. And exports were down by 0.5%. So it's the story that we have been seeing is the big pull forward into the first quarter of trade. And then second quarter, that has reversed. And that's one reason we got a stronger than expected growth figure for the second quarter. Now, from here on, we'll be into the third quarter numbers, and we'll see what happens.
We're seeing right now not a huge response in markets on the heels of that, although, as you said, that this is what a number of people were looking for, and the expectation that as you increase the barriers, the volume of trade does go down. In the bond space, not a whole lot of reaction. S&P futures retrace just a touch. Russell's 2000 as well, up only 0.3% off the session highs. As we look forward in the bond space, actually getting a little bit more of a bid at the long end, up about 1 basis point, 4.8% in the currency space, holding steady with just a touch of dollar strength, euro weakness as we look forward to understand exactly the strength versus the rate cuts. Mike, before you go, we also are hearing about possibly replacing the Fed chair. We've been hearing a lot about this and saying that maybe the seat for Adriana Kugler could be used as a sort of backdoor into the next Fed chair. What do we know about that?
Well, the president has a choice to make here. He can appoint someone to the Kugler seat that he would anticipate being the Fed chair. They would likely be confirmed by the first of the year, which would leave us in the situation of having a so-called shadow Fed chair, someone who the markets might listen to more than the current Fed chair, Jay Powell. Powell may not leave as a governor at the end of his term as chair. So it is a gamble for the president. And his other option is to put someone in there and then make a choice if Powell doesn't leave between somebody who's already on the Fed, like Mickey Bowman or Chris Waller, and the person he puts in there. But that would be sort of like the Apprentice show and be a little awkward as well. Probably your best bet is that we get someone who will be the likely Fed chair, and I would imagine that whomever he names to the Kugler seat will be seen that way on Wall Street.
And that person could be one of two Kevins or a couple of other people, as we keep hearing. Joining us now, thank you so much, Michael McKee. Dana Peterson of the Conference Board is coming with us at a time when there are real questions about the integrity of data and data collection. Before we get into the state of the economy, I'd love your take on how much more difficult it's gotten to collect data and how much we've really got to focus put on that over the past couple of days.
Certainly is more challenging if you have fewer responses, but I still think we can trust the government data. It is a benchmark. Many people look towards that to understand what's going on in the economy. And certainly when you look at revisions, you're always going to get revisions for certain measures because you don't have all the information right away. And economists, markets like advanced numbers, but if you get advanced numbers, you have to anticipate revisions. And indeed, the revisions we did see in the payrolls data were mainly concentrated in one sector. It was government. And then after that was leisure and hospitality, which we know has been under pressure for more than a year.
Going forward, do you think we're going to see a continued weakness, almost a trend when it comes to the type of numbers we're getting from the non-farm payrolls?
Well, yes, and that's something I've been saying for a long time, and it's something Chair Powell has also been saying. When you're at or near full employment, you don't need giant increases in payrolls month after month, because if you think of it as a bathtub, you filled up the bathtub. So there's no more room for companies to hire people. And indeed, that story is still here. Last year, many companies were on the sidelines, and this year they had even more reasons to remain on the sidelines in terms of hiring. Last year, I think it's because they had everyone they needed. This year, it's because of uncertainty. Now, some of those uncertainties have lifted, but there's still, much more to come in terms of how consumers behave. But the industries that have been hiring this year, the same ones that hired last year, those who are suffering from severe labor shortages, like education, also healthcare. And the industries that have been cutting workers, for the most part, are still the ones that were cutting workers last year. That's tech and also at finance. But we are seeing some erosion in those industries that are directly impacted by tariffs.
If this is a bathtub and there's no more room for hiring, will the drain open? Is there room for firing?
That's the big question. And certainly over the course of the first half of the year, many companies, even in our own surveys, our CEO confidence survey, were basically not doing anything. They were just sitting there waiting to see what the outcomes would be with regards to fiscal policy and also trade policy. And still, that's not really clear. And so many companies are probably still sitting on the sidelines. And I think that's evident when you look at the JOLTS data. You may see hirings being low, but there are very few firings, and also initial jobless claims remain near historical lows.
At this point going forward, do you think that the market is adequately accounting for the potential weakness that you see in the data that you see, as well as what we heard on Friday?
Well, again, I don't think the labor market is falling off the cliff. When I look at other elements of labor market data, they're still pretty positive. The unemployment rate's very low. Yes, some of that reflects retirements and also immigration policies. But you still see very few industries letting anybody go. And when you do see it on the margins, again, it's in those sectors that we know are directly impacted by tariffs. For example, tariffs and immigration policy. So that's like construction, retail, transportation, and warehousing. But that's to be expected when you have a 10% tariff on all goods coming in. Also, when I look at wages and benefits, while the pace has slowed, which makes sense because you don't have that labor shortages emergency anymore, wages and benefits are still growing at a clip that is far more elevated than what we saw between the great financial crisis and the pandemic. So I'm not convinced that the labor market is falling in on itself. Again, when you look at the revisions, they were concentrated in mainly two areas. But when I look at other things like demand, retail sales, consumption, that's definitely weakening. The housing market is not doing well because of a lack of affordability. And also businesses are in stasis when it comes to investments. And some businesses will actually stop investments, especially those that lost certain types of tax credits.
Dana Peterson of the Conference Board, thank you so much for being with us this morning. Dana was talking about how wages are actually increasing and that wage growth actually is more significant than it was during the Great Recession back in 2008 and the beginning of the pandemic. This comes at a time where people are trying to understand the ramifications from immigration, especially given the fact that it's unclear how many people have left, how many people are going to leave, and what the policy is going to be going forward.
And that is why it is so interesting when Jay Powell, the Fed chair, talks about how he's looking at the unemployment rate because of what is happening right now in supply and demand. You actually had the president speaking this morning to the media talking about how they're going to potentially come out and have different rules when it comes to immigrant workers in farming, because this is a host of their supply when it comes to this industry.
Yeah, said you can't replace immigrant workers in farming easily, and this comes with a number of constituents complaining, saying we're not able to farm our fields based on the fear that people have from showing up. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Top aides for Indian Prime Minister Narendra Modi will travel to Russia in the coming days. That's according to officials familiar who tell us here at Bloomberg that India's national security advisor will visit this week and its external affairs minister will follow later this month. Both trips were scheduled before President Trump ramped up his tariff threats against India over its ties to Russia. Meanwhile, chip-making giant TSMC has fired several employees and launched legal action over a suspected leak of secrets related to its advanced chip-making techniques. The breach was caught during an internal probe with mass production of the next-gen technology set to begin this year. The tech will ultimately be used to power a number of devices from smartphones to AI accelerators. And sticking with chips, the U.S. is exploring ways to equip semiconductors with better location tracking capabilities. A senior official sharing Washington is working with the industry to monitor the movements of sensitive components as part of a broader plan to curtail smuggling and protect American tech dominance. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, setting you up for the day ahead, plus Flexport Chief Executive Officer Ryan Peterson on how tariffs are hitting supply chains and how some of the suppliers are scrambling ahead of Thursday. This is Bloomberg Surveillance.
the BLS is still the gold standard. Of course, there's a smattering of data and evidence that we look at, regardless of what phase of the cycle that we're in. But when it comes to the labor market, it is about the BLS statistics. What was really important about Friday's data point is that it showed that some of the early signs of cracks in the labor market actually did make a trend with the revisions that we saw.
That was Lauren Goodwin of New York Life, pointing to what a number of people said, that actually this data really did confirm what a lot of people had been expecting. She also did say that the Bureau of Labor Statistics still is the gold standard for economic data on the labor market. Right now, when it comes to market activity, about 45 minutes away from the markets open, we do see JPMorgan shares erasing gains and seeing some losses in pre-market trading, down about 0.25% after President Trump, in comments to media, claimed that JPMorgan discriminated against him. He has been saying that in general, some of the large banks discriminate against conservatives and is actually investigating that more thoroughly.
Right, and the White House, according to the Wall Street Journal, is starting to step up the pressure against some of these big banks, and they have a draft of this executive order, which they viewed, so looking at bank regulators to invest whether any financial institutions might have violated the Equal Credit Opportunity Act, antitrust laws, or consumer financial protection laws. Now, we've heard from the banks a number of times, whether or not it's Jamie Dimon or Brian Moynihan, saying they constantly and consistently follow the law when it comes to whether or not if they have individuals on their platform. But the president is once again going after them, and we should get this executive order this week at some point.
The Wall Street Journal had that information and quoted Brian Moynihan of Bank of America saying that they welcome any investigation, but denying any particular type of discrimination as to all of the banks. Meanwhile, in broader markets, you do see broad-based gains continuing for a second straight day after yesterday's biggest day going back to May, although fading just a touch after the trade data and after some of the headlines that we've been seeing. S&P futures up not quite 0.2%. 10-year yields higher by just about 2 basis points. Counting down to the opening bell, here's the trading diary for the week ahead. 9:45 a.m. PMI data followed by ISM data shortly thereafter. That comes at 10 a.m. 1 p.m. Eastern. The Treasury auctioning $58 billion in 3-year notes after the closing bell. AMD reporting earnings on Wednesday. More Fed speak, and this is going to be interesting, from Mary Daly of the San Francisco Fed, who made news this morning, as well as Cook and Collins, Lisa Cook and Susan Collins, plus Disney results Thursday, a rate decision from the Bank of England, and another round of jobless claims. Plus, President Trump's new global tariffs will take effect. What I find interesting right now, Annmarie, is how much we are or are not recognizing the ramifications of tariffs that are substantially higher where they have been since the late 1930s.
Exactly. The average U.S. tariff rate was 2.4%. Now we're going to an aggregate rate of some 20%. This is going to be massive, and a lot of people are saying companies still have not digested it. You also have a number of countries like India, like Switzerland, wanting to, I think as Ambassador Greer would call it, manifest a deal in the last minute. You even have the Swiss president, which I am told uninvited by this White House, no formal invitation to come, getting on a plane to come to Washington, D.C. to try to ink a deal in less than 48 hours.
Meanwhile, we do have the Trump administration providing new guidance ahead of the rollout. Bloomberg's Mike Shepard joining us now. Mike, what are we learning from the administration as they prepare for these new rates to go into effect on Thursday?
Yeah, the rates will begin to be enforced, Lisa, on Thursday after 12:01 a.m. That is, anything that is put on a boat or an airplane or in a truck heading into the U.S. would be subject to these higher tariff rates. Now, that still buys a little bit of time for those handful of nations like Switzerland, like India, and even like Brazil that would like to see the rates that they were handed by President Donald Trump last week to be dropped from where they are right now. The Swiss in particular are smarting over the 39% levy that the president imposed on Thursday. This is really the fruit of a falling out between him and his Swiss counterpart, Karin Keller-Sutter, who didn't quite grasp Donald Trump's misgivings over the trade deficit that the U.S. currently has with Switzerland. During an interview just now on the other network, the president pointed to that and pointed to his frustration with that conversation, and that really led to that higher number. We've reported ourselves just on some of the internal workings of that conversation between the two leaders. Now, the Swiss president is hoping to have another encounter with the president or his team to see if they can work out a different deal with some concessions. Likewise, we're looking for India to see if they can come up with some sort of counteroffer before Thursday to lower the tariff rate that they are currently expecting of 25%. And again, President Donald Trump has expressed his concern that India still maintains tariff barriers that are too high and also some non-tariff barriers on key American goods, including in agriculture. And he would like to see those lowered as well. But lurking the India conversation is something else altogether, Lisa. This is the Ukraine war, and the president wants to get India to stop buying Russian crude. He sees that as a way to support Vladimir Putin's war machine. He has grown frustrated with the Russian leaders' refusal to come to the bargaining table to try to agree to a ceasefire to end this war and deliver a campaign promise that Donald Trump had been making consistently before the election and, of course, repeatedly afterward. And he has grown tired of trying to cajole Vladimir Putin and would rather use the economic instruments at hand. And that would include getting trading partners like India and like China to stop buying energy products from Russia. Likewise, we're also seeing some pressure on Brazil for different reasons altogether. And that is what has led to the high tariff rate there. And that is a 50% levy on Brazilian goods coming into the U.S. And this is over President Donald Trump's concern that his ally, Jair Bolsonaro, is facing unfair treatment over the charges he is facing for a role in an alleged coup plot against the current president, Luiz Inácio Lula da Silva. So we'll have to be watching that all. Lisa and Annmarie, it'll be a big day today and a big rest of the week.
Shep, we also seem to get confirmation of something that the Treasury Secretary has pretty much signaled. He doesn't want the job at the Fed. He likes where he is.
Yes, he does. And the president made very clear that he had 4 candidates. He talked about the 2 Kevins, Kevin Warsh and Kevin Hassett, as being contenders. But he made clear that Scott Bessent really wanted to stay in his role as Treasury Secretary. He was enjoying the job. And he made clear that, look, Scott Bessent's name can come off the list, the one that we have been maintaining here, many other media outlets have been maintaining, and looking to see who might succeed Jerome Powell as chair of the Fed here.
Mike Shepard of Bloomberg, thank you so much for being with us this morning. President Donald Trump wrapping up comments on trade, JPMorgan, and picks for the Fed and the Bureau of Labor Statistics. Bloomberg's Michael McKee back with us. Mike, we knew a lot of this heading into some of these comments. Still, what are you hearing from people about what the process looks like to have a replacement to Adriana Kugler, how long it would take, and what that means for Fed Chair Jay Powell?
Well, the timing is difficult. The president gets a chance to nominate somebody early for the Kugler seat, although he could have done it really any time. The question is, when can the Senate get to it? They're out for the month of August. They come back. They have to deal with the budget first. So that could take up a lot of time. And if we did get into a situation where they were going to have a government shutdown, that would put everything on hold for a while. If he nominates somebody who has not been confirmed before by the Senate, or somebody whose confirmation, like Kevin Warsh, was a long time ago, they're going to have to fill out a lot of paperwork. That takes time before it gets to the Senate Banking Committee. Then they have to hold a hearing, and then it would go to the floor. And we know the floor is kind of backed up with a lot of judge and other nominations that they have to vote on. So it may not get the president a whole lot of time in advance of when Kugler would leave, unless you're looking at having a chairman in waiting, in which case that person would probably be in office by December or January and would be able to counter anything that Powell said and maybe confuse the markets a bit.
Mike, right now the market is pricing in almost a 92% chance of a Fed rate cut next month. And this comes after what we got on Friday, which showed a much more rapidly deteriorating labor picture based on the revisions. How much do you think that really did single-handedly change the view of a number of Fed members? We did hear from Mary Daly of the San Francisco Federal Reserve talking about how one rate cut, maybe even 2, could be in order.
Well, you remember when Mary Daly talked with us a couple of weeks ago, she said that she couldn't wait forever. And that was her line last night, basically, that she's at the end of her patience. And I think that's what you'll find with a number of people on the Fed. They have been anticipating that the data that they got between their meeting and the next meeting on September 17th would help them make up their minds, because they'd have more employment data, more inflation data. And I think that's what you're seeing now is Daly, and we'll probably hear it from others, are going to say something like, if this is what we have in September, then yes, we're ready to cut rates. The big question is, what does inflation do? Right now, it looks like the labor market has some of the cracks that Chris Waller was talking about. But we did see inflation rise a little bit, particularly the PCE, which is the Fed's target index. And if that continues, then it's a little bit harder for them in September, depending on how high and how fast it rises.
Michael McKee, thank you so much. As always, and this is one reason why people are watching the tariffs go into effect on Thursday and how much this starts to have more significant ramifications for pricing.
Does it actually bleed into companies, and is it going to be more than just a one-time price adjustment, which is what Mary Daly was talking about, though. She says if we do see that this actually has an inflationary impact, well, then we can hike rates again. But right now, with the concern in the labor market, she's thinking it's time.
If the labor market isn't running hot, then why would people have the confidence to go out and accept higher prices? And on the margins, you are seeing signs of this, with companies saying that they don't have as much pricing power. It remains to be seen, and it remains to be seen in particular industries, how much each are affected. Coming up tomorrow, Steve Auth of Federated will be joining us, as well as Anastasia Amoroso of Partners Group, Daryl Kronk of Wells Fargo, and Rich Greenfield of Lightshed, as we look at a potential another day of gains on AI exuberance following Palantir's earnings and ahead of AMD. This was Bloomberg Surveillance.